up this trading day. Futures close at the top of the hour. If you're on the website, if you're on the platform, come over to YouTube. Tell us what you're trading, what you think of this rebound off the lows. I'll ask you the same question that Tom asked, or Tony asked rather, are the lows in? To that end, if you're already on YouTube asking and answering those questions, come over to the platform, see what we're all about, tastylive.com as well. Guys, it was a topsy-turvy morning. We didn't quite take out the lows. We rallied back. We don't quite take out yesterday's highs. It's an inside day for the S&P 500, which is up by 0.95% now. The Nasdaq up by about 1%. Dow Jones up 1.09%, and the Russell, the laggard, still up 0.87%. Bond yields are higher across the curve. Oil prices are breaking down. Metals are surging on the back of a Chinese announcement that they will continue central planning. And ultimately, we see the dollar falls apart. The euro is on a tear, as Ilya noted on last call. Some of the biggest moves that we've seen in the German Bund market in decades. And that is setting the stage for an ECB meeting tomorrow. But guys, we got to go right to stocks because this is the main market as we're paying attention to it. Volatility comes in a little bit, but not really a lot. It's still a 40.6 IVR. We are bouncing on that 200-day moving average, which I suppose is a good thing, but we have yet to scale the 1-week moving average. So Ilya, with the ECB tomorrow and non-farm payrolls on Friday, do we have lows here in place?
I think just looking at the price action, the natural answer is no, because or at least we don't know that they're in, and we can't make the call. Because if you look at what's been going on here, it's been a very clean stair step down. Just take a look at the last big green candle. We had the break of the most generous version of the up moves bounds from the August lows. That's that yellow line there. I say the most generous because it doesn't run the sort of internal lows. It runs a very wide reading of what the uptrend is. And back in sort of late February, we cracked that. Look at that green candle, the last green one before today. It's a very clean retest of the underside of the prior range before we get resumption. What do we see today? The same thing. We gap a little bit higher at the futures reopen. We don't ultimately end up going anywhere, and we just test the underside of that green candle of the prior stair step. So this looks like a retracement on the way down, not a confirmed reversal of anything. Now, could we get a reversal after this with one more candle or a little bit more of a further push higher? Sure. I'm certainly open-minded to the idea that this could be confirmed as some kind of an intermediate bottom over the course of the next day or two. But as it stands right here, if I was not if I didn't have any exposure, I would not be a buyer. And as a seller from the highs in early December and the top of this range, I am not shaken out of my exposure.
Dylan, are green shoots emerging in these markets after what's been a rough 2 weeks?
Well, no, I mean, I think this would be what I'd say. The question is this the ultimate buy the Trump tariff madness opportunity? Because basically the only thing that really lives in this all this madness is some version of a tariff reversal of consequence that we have seen in the past, especially on the Mexico and the Canada tip. They already did a carve out for the automakers, apparently. I mean, who knows, with the way the headlines fly around. So, I mean, I think that's this is one of those charts where, like, either, this is a great opportunity to buy them, but you're straight gambling. You're just gambling that Trump is not going to do what he says, because generally he doesn't do what he says.
So is this the ultimate?
There's not going to be war in the Middle East, and what's that?
So is this then the low to buy?
I know. I mean, that is the only question. I think, Tom really hit it on the head, which is, I think the rational thing here is to take advantage of is to try to not have to pick a direction, because nobody knows if this is the low to buy, and take advantage of expanded volatility, which exists, and try to stay neutral. because I don't think anybody can say with conviction which way this thing's going to go, if any which way. But you can say that volatility has expanded a touch over the past, this past week or whatever, and certainly over the past few days, and that this is a good time to be sort of an old school or a new school, I guess, but whatever, a tasty trader, stay directionally neutral and sell some premium. Seems to be the only logical new trade to originate right now. Everything else is, a coin toss on a good day and a suicide mission on a bad day.
Dylan, I let's entertain that here, right? You may be onto something. You talk about being directionally neutral and looking to take advantage in the typical tasty methodology. We are currently sitting at the midpoint, effectively, between the lows that we have in early September to where we go to the highs in December in the NQH5 contract. If we were to go out 43 days, we were to look at a short iron condor trade. We short the strikes at 22K and 19K. We go 250 points wide for the wings to buy back. That gives you a 63% probability of profit, basically a 2-to-1, risking 2 to make 1 here. What's notable about those levels where the short strikes lie and where you buy back the wings, they are right on the opposite ends of the lows in September and then the highs that you have in December. So unless we immediately go back to the highs or we go down to the lows and we can grind this out for the next week or two trading within this range, there probably is a good directionally neutral opportunity here. So for the sake of having a few minutes left before and while we can get some things filled, let's get this off and potentially working. If not, I'll put it back on when the futures market reopens tonight and try to get it filled. But I think that this is actually, that's the first way to play this. And this can be structured in a number of ways.
It's the only thing that has some logic that's not just pure spec, just, straight up gambling.
Right. And on Futures Power Hour today, Thomas and I, Westwater and I, were looking at, the conditions for what we would do to size up and play a swing off the lows here. And specifically, I mentioned that I'd like to see a close back above the 1 week moving average. The 1 week EMA here in both ES or NQ, and both ES and NQ treated that as resistance today. We rallied up into the 1 week. We failed to close above it. We haven't closed above it since February 20th in NQ over in ES. It's a very similar story. We haven't closed above it since basically the 19th, 20th here. Likewise, what do we see? We can't get back above that 1 week moving average today on our chart despite our bounce. So it feels like it's a hold right now of the 200 that would draw some people in right out a pretty clear swing zone. This would be a great place for a low to be formed. But I like to be a little bit more confident that the near-term directional momentum's been broken before taking a stab. And that could simply be by time, right? We could trade sideways and then perk up, and that's that. Or we could make a V bottom. We don't seem to be doing it just yet, which is one of the reasons why I'm still sitting on my hands idly, at least in the stock market for now. But I do like the directionally neutral trade, Dylan. So I have that on the board here. If that gets triggered, it'll go to the Tasty Live follow page. If not, I'll make sure that it gets put back on after the market reopens tonight.
I don't know if I believe that vol contraction is what's next. I think if you're making the bet here that you don't know where this thing is going, and all you're looking to do is for things to settle. Okay, yeah, maybe, but when things settle, given where vol is currently, I mean, just take a look at the VIX. If things settle here, I mean, that implies directionally that you get a relief, because obviously we've had a strong sell-off, and that strong sell-off has come with vol expansion. So if you're betting on vol expansion, you're betting on a bounce. And if you're betting on a bounce directionally, I think you're a little bit early. So,
but couldn't you be betting on the end of sell on a reduced rate of decline as well?
Perhaps. So I think that becomes a very kind of narrow needle to thread. You're essentially saying, I want the decline to slow, but the decline hasn't been that fast. So doesn't seem like there's that much there. I mean, yes, for a day or two, I could see this thing idle. I could see vol come in as the S&P basically stalls right here and hangs out until we get Powell and NFP on Friday. And that could give you some IV to extract. But the trade might be no more than a 48-hour kind of adventure, because after Powell and NFP, it seems like whatever the market would be waiting for, that signal would be there. And then maybe you get an explosive end.
But it also feels like the market is now driven entirely by the White House and not by AI or the jobs market or inflation. That it's driven by an executive policy that is different than anything that's been seen in some time.
And this is really the essence of what we were talking about yesterday, that if you're getting stuck on tariff headlines, you might be missing the point, because the issue isn't the tariffs. Yesterday's seesaw in markets, first you get, the tariffs are going, markets sell off, then they rapidly come back to scratch. Why? Mainly tech, mainly NASDAQ. Why? Well, because most of U.S. growth is the service sector. The service sector is mainly serviced domestically. It's U.S. firms in there. That's been the main kind of pocket of growth globally. It hasn't spilled over even to Canada because it's services and not goods. So, okay, you put a bunch of tariffs on Canadian and Mexican goods, but goods demand is weak anyway. Do you really hurt U.S. growth by doing that? Not really. But you also don't really save U.S. growth, because the problem with U.S. growth isn't in goods at all. It's in services. And so the reason the markets are afraid of recession isn't the tariffs. If you thought that relief on the tariffs was going to take away the market's concern about recession risk, it's not. That isn't where the recession risk is coming from. The tariffs aren't good for growth, but they're not the incrementally decisive factor.
Yeah, I mean, the question that the Fed has to address is whether or not the tariffs are going to lead to a one-off rise in prices or a continuous rise in inflation. And the tariffs initially are probably inflationary up front, but if the cost of goods goes up, people are going to ultimately scale back consumption. Consumption flatlines or falls, right? You know, if I have to buy widgets from Canada and they cost me $1, but now I can only buy them in the U.S. because of the tariffs for $2, right? Or I can import them from Canada for $2, but I'm a patriot, so I buy them here in America for $2. That means I still have $1 less to spend elsewhere, right? So it could lead to a drop in overall output. It could lead to a drop in real incomes after an initial inflation spike. Commerce Secretary Howard Lutnick said as much today. People are going to have to deal with higher prices for a little while. That's what happens with tariffs, and it's nice to see people from the administration finally suggesting as such. But I think it's the tariff news today that sparks this all around, right? We hear that the USMCA pass-through for auto tariffs will be in place at least for the next month. The big three automakers, Stellantis, GM, Ford, seeking the administration's reprisal, and ultimately they get it. Dylan, I think you're speaking to a point that I certainly feel right now, which is to say that the market isn't being afforded the opportunity to pay attention to anything else, that it's tariff
and I don't
or bust.
Yeah, I mean, I would say that, and for me, I also just don't think that it's tariffs, although obviously it's tariffs. I think it's an attempt to recalibrate to an entirely different philosophy of economic policy making that ranges from the wars. We're not going to pay for a war with Russia. We're going to make the Europeans pay for it. So we'll bump all European rates higher. We're going to internalize all the tariff rhetoric, which we just went over, and then beyond that, this is surely rhetorical, but that we want to get rid of the income tax, that we want to that the view of tax policy in general is not what it has been or was for the last, since 1913. To listen, if you were to take the president at his word, which is obviously, illogical, but there's been a philosophy on taxation in America that's been the same, some version of the same, since 2000, or excuse me, since 1913. So for 90 odd years, 92 years. And the new administration is going back to a tax policy from the late 1890s. And that nobody really knows what that means in terms of all of the financial metrics. Does that mean a stronger dollar? Does that mean a weaker dollar? What does that mean for equity? What does that mean for growth? I mean, it just layers in through all of that. And I think that the tariffs on Canada are like the proof that they're serious in their minds, if that makes any sense.
I think it's really interesting that the tariffs on Canada are being talked about at the same time that we are Trump's discussing treating Canada like the 51st state. One of the main reasons why McKinley put the tariffs on in 1890 was a way to cripple Canadian industry so that taking over the country would be easier. So the tariff conversation with Canada, I mean, like you saw Trudeau yesterday, he was pretty adamant. Like we've stopped basically all the fentanyl flow across the border. We got it down from less than a few pounds to less than an ounce. We can't really stop anymore. By the way, most of the people bringing in the fentanyl are American citizens, Mr. Trump. What more do you want from us? And if Trump keeps praising these McKinley tariffs while calling him Governor Trudeau, and he keeps saying it's going to be the 51st state, I mean, like, I think someone just showed him a book about what William McKinley did in 1890. And Trump's like, yeah, I'm going to do that again, because it's the same exact playbook at this point in time, the more I think about it. And Ilya knows I've been on a tear reading American history. So like coming across that recently, that's fascinating. I
agree with that. And I think that that's why the markets become more interesting, because it's not just a traditional tariff kind of discussion or tariff, thesis. It is an apparent attempt by the new American president to resurrect the economic ethos and philosophical thesis of the 1890s, which ironically was the era of the robber barons. I mean, that was Rockefeller and Carnegie and that was the anyway. If you read that was a moment of extreme concentrated power and wealth, sort of that preceded the trust busting or the antitrust movement of Teddy Roosevelt, which is probably 10 to 15 years in America's future if this keeps up.
Yeah, I mean, if you read the great biography of the House of Morgan, the House of J.P. Morgan from Ron Chernow, you really get a sense for just how much the entire thing was really in the hands of a very small group of bankers and industrialists, and the lay of the land, I mean, I think Dylan's absolutely right, is starting to look very much like that.
Well, concentrated market power, probably bad for people, probably good for corporations. Guys, the Mag 7 index ETF, MAGS, is bouncing at its 200-day moving average here, but not quite back above its 1 week just yet. Dylan, we talk about 5% pullbacks in this market being good opportunities. It's been way more than that here in the Mag 7. We peak in December. That's a high on the 18th, 58.69. So we're down to 50. So we're down, 16%? That's not nothing. Is a 16% discount the best it's going to get? Or don't bother yet? Bueller.
I think at this point, if you are going to have a bet on equities, it probably doesn't, to sort of the thrust of what we're talking about, it probably doesn't behoove you to try to get cute about sectors, because this seems like the kind of an environment where everything looks the same and the correlations are going toward one. I think last week was a great example of a sort of liquidation-like dynamic where even gold got sold just because everything was going to cash. We certainly see it across the breadth of U.S. equities. And if there's a generalized risk-off thing that's going on here, there's so much market cap that's in a skewed, lopsided way buried in the mags and buried in tech, that's the place for which liquidation comes first. So if you're going to be selling whatever is not nailed down, you're going to be obviously first not wanting to lose whatever incremental P&L you've secured on what has been the outperforming part of the market. So one would think, don't assume that there is anything separate occurring for the mags than there is for the overall landscape, and thereby operate as you would in the S&P or in the NASDAQ. And from that perspective, what you've seen over the past 2 days has been corrective at best until further notice. Now, maybe tomorrow it'll stop looking corrective and start looking like a bottom, but I don't think we know that yet.
My thing, every time the market has gotten pounded, buying it has been the most winning strategy ever invented.
Just buying the 5 or 10% dip in this market. S&P was
the question is when.
Over and over and over again. COVID this, inflation that, war this. And every time it's like, this time is different.
Yeah, but the question is when, right? If you bought the COVID sell-off in February, you were too early by about a month, right? And you had to have tremendous intestinal fortitude to say, you know what, this is fine, and not be on a 45 DTE cycle, but to just outright own things, not be leveraged, or just own a ton of duration, and have the intestinal fortitude to be like, you know what, I bought too early, and the thing to do is to keep buying until eventually it bottoms. I don't disagree in the slightest that the trajectory for U.S. equities and equities in general, but U.S. equities in particular, is historically and even near term very biased to the upside. But that does not mean that this is a tradable bottom to buy necessarily. Again, maybe it is. I think we'll see. But there could be another 5-10% of losses behind this as easily as this could be the bottom at this point. So yes, it has been the right thing to buy the dip. But if you bought the GFC dip in December, you regretted it. You should have bought the March one.
I think the difference this time, Dylan, is that the growth scare is happening. And,
Yes.
We can quibble about growth scare and what does that really mean and all this. But the fact is that oil's down, yields are down, broadly speaking. The dollar's down, not benefiting from this because interest rate differentials are moving against it. Fed cut odds are up and stock markets, going through a bit of a thing here the past 10 days. So I guess the question is oil, guys, this has now shown some verticality a little bit more. We touched
word right there.
Yeah, well, we're no longer sideways shuffling. We are clearly reaching some escape velocity to the downside, but we fell into an area where the market's bottomed out previously.
Yeah.
So, Dylan, I guess I want to ask you this. If you were willing to sell rallies in oil for various geopolitical reasons, do you find the same level of interest in looking to fade some weakness on purported growth concerns, given everything that we know, what's going on in the world, and it's a 20.3 IVR? Do you try to catch the falling knife?
No way. I mean, if anything, why wouldn't you just? Maybe you'd sell some put spreads, I've been short oil, and it's the only thing that's worked for me in this whole mess, as I've said a billion times. But I maybe some put spreads.
Do you catch the falling knife here, Elia?
I don't think you try. I think the lay of the land, and as you know, I traded the move down in crude from about 77 to maybe like 72. And then when it stalled there above 71 or so, 70, like upper 70s, 71, that's where I got out and just moved to wait and see mode. So I missed this last leg, these last $2 or so, $4. So I'm inclined to be short, but I haven't reloaded yet. And I think it's the risk reward here. You're hitting, as you said, the bottom of that congestion that we can see on the chart. So you're right at support. I don't think anything tells you you're necessarily going to hold that support, and you may well push right through it with the right mix of NFP data and Powell commentary in a mere 48 hours less. So I'm a little bit circumspect. I'd rather sell the break. Of course, ideally, there is a bounce. It gets to something like a 69. It does a test of the underside that it just broke at that former swing low, right on that yellow upward sloping line that you have there, the last test before we cracked through it over the past 3 days. That low, that would be ideal. You get a bounce there, I want to be a seller right there. But I would take selling a break. I just don't see why buying crude oil lines up with anything that's happening on a macro level. There is a global growth scare that has motivated a lot of this recently. There is a situation where you probably have at least a bias, never mind capacity, but at least a bias from the current administration to output more. It's unclear how much more they can really output. We're already at record output, making the most petroleum products ever, in fact, more than Russia and Saudi combined. So I'm not sure where we get sort of incremental output. We could, if we really wanted to ramp things up. The number of oil rigs has been declining even as we've increased output. The number of fracking operations out there has been declining because we've gotten really, really efficient. So I suppose you could have some sort of federal mandate and incentive set to turn those things back on. But at some point, that does start to become counterproductive. Prices fall such that it's no longer economically viable without subsidies, and maybe you get enough subsidy, but it does look like, at least bias-wise, it's toward more output and less demand. That doesn't mean that we're going to fall off a cliff tomorrow, but it doesn't look like the kind of an environment where you should be expecting structurally higher oil.
Yeah, oil prices are in a throw right now. I mean, I guess what I find so interesting about the oil move today is that it doesn't respond positively whatsoever to the Chinese fiscal announcement last night in the same degree that we see with Chinese stocks or even copper prices, which are up 5.49% today. Chinese stocks up 5% themselves, now closing at a fresh yearly high. It's actually higher than we closed at any point in 2024.
Mind you, these are Hong Kong names. So all of that is listed in Hong Kong. If you look at ASHR, it's much more circumspect. You're still in the same range for mainland shares, which has been a story in recent weeks. Things listed in Hong Kong go higher. Things listed on mainland go nowhere. And that sort of comports with flows we've seen along the Stock Connect that bridges mainland and offshore Hong Kong markets, and it's been flowing one way. Money is not flowing onto the mainland, that is northbound. It's flowing out of the mainland to boost Hong Kong stocks, that is southbound. That does not look like optimism in China's ability to revive its economy. It looks like a way for people to get their money out of the mainland through Hong Kong because they don't have that confidence. So it's an interesting set of circumstances here. If we get a mainland stocks rally tonight, of course, that will be a different story. But so far, this doesn't look like optimism in China's ability to land this thing. It looks like the opposite. It looks like money's running away from it.
Dylan, what's the word on China now from Europe? It feels like the world is shifting beneath our feet. Relationships
No,
are
I mean,
coming
I think
apart.
that it's not even the word from Europe is the biggest move in the bond market since the Berlin Wall came down. How do you like that for anything? Okay. The hell with China. All right. It's the biggest move in the bond market in Germany, which is the biggest economy in Europe, since 1989. Okay. And so whatever is going on, there's been a massive policy, a cataclysmic multi-decade policy shift has been internalized in Europe. Going back, so let's say it started with the J.D. Vance speech, whatever it was at Munich a couple of weeks ago, which was you're on your own. And then the consistency of the Trump White House and whatever has been coming out of Rubio, and then this Zelensky dispute, public dispute. And then the speech from Trump last night. And so if you keep going and going and going with it, obviously Germany has taken, and Europe is taking the American government seriously when the American government says to Europe, you are on your own. And so if you wanted to know what is the value of the American subsidy to the European, meaning specifically the American defense subsidy of Europe, it is whatever the move today was in the German bond and the French, I mean, it was across all the Euro bonds, Italian bonds, everybody got a bump. But it also makes you wonder, okay, there's going to be, I don't know what the number was, but it's hundreds of billions of euros are about to be spent on European infrastructure, and Germany is going to stand up a military, apparently.
Historically,
which has not happened since World War II.
Oh, well, I was going to say, historically, that's worked out well for the rest of us.
I mean, it rhymes, it doesn't, it's history rhymes, so who knows what it ultimately means. But
what does it mean?
It means a stronger euro. It means a stronger euro, and it means higher borrowing costs in Europe. I mean, that's what it means.
Yeah, what's really fascinating, Elia? Like, we talked about this in November, got a lot of it right. Geez, I got a big thing wrong. It was good looking for most of the end of last year. I think, to talk about this rally, Polish equities, best performing equity market in the world right now. Okay. Yeah. And it's all come in the past few weeks. Post-election, they were stumbling out of the gate. So what's changed? What changed the equation for EZU, for the German DAX, for European equities? I think the biggest story of perhaps the first part of my career in finance was how governments in the United States and Europe were handling the post-global financial crisis wounds. The United States and Europe both opt for austerity to varying degrees. Europe is a lot more strict about it. Germany's in control. The United States, we still run budget deficits. They're just smaller, but we still run budget deficits. So we've been spending a lot more money and continuing to add and add and add to debt in ways that Europe hasn't been. And the question that we've been asking for the past 15, 20 years almost has been, when is Europe going to finally do the spending to move closer towards federal union? Less Articles of Confederation, more constitutional America, right? When are they going to make that jump into the same sovereign risk pool and do what's needed to become a world superpower, as opposed to, they are basically the Confederation of European states right now. There's easiest way to think about it in terms of how our government has worked over here over the 249 years. And so to that end, right, the fact that they're actually doing something, they're removing the debt brake, they're putting together a 500 billion euro fund. these are the things that people have always talked about happening, hoping happening. Maybe they need to happen. Will they happen? Probably not. It's Europe. Forget about them. I mean, they're actually putting rubber to the road now. And so taking that a step further, right? If we are thinking about a Europe that is now seeing a huge surge in fiscal stimulus,
Huge.
and if we enormous, right? If the United States today were to unveil a $500 billion spending plan on military outside of the normal confines of its budget, people would say that's a lot more money, right? So
Yeah.
if Europe is doing this right now, if we're seeing that America's standing in the world is seen as less reliable in terms of a partner, right? America's place in the world is basically you make a deal with America, you're in our security umbrella, we honor those contracts, and we got your back. And now it doesn't feel like that so much anymore. So could this become a drag on U.S. equity markets for the foreseeable future, where incremental allocators are saying, forget the uncertainty of trade with Trump, Mexico, Canada, China, right? Like Europe right now, they're spending a ton of money. We don't need to worry about spending cuts, austerity anymore. All these low PE ratio companies, like there's a great deal of value there. And we don't need to worry about the 29 PE with, XYZ ticker that's in the Mag 7.
I mean,
Dylan,
that makes a lot of sense. That makes a lot of sense. I mean, if you look at the fiscal impulse, I mean, I think you're absolutely right. If you look at the fiscal impulse, what are you seeing in the U.S.? The biggest fiscal impulse in a positive direction is we are going to take the tax cuts we already passed in 2017 and we're going to extend them. That's okay, fine, growth supportive. But to pay for that, we're apparently taking an axe to all kinds of other government spending in a very rapid, wanton kind of way. Because obviously, if we were to extend these tax cuts, they would blow out deficit expectations. So we extend them. Okay, maybe we reshuffle them for a little bit more of a SALT deduction, which Republicans in high tax states like New York and California want to get done. That's probably the price of admission on extending the tax cuts. That's the positive side of it. The flip side of it is the Doge axe and how you pay for these things. And so the impulse in the U.S., at least fiscally, is, let's call it, not uniformly a tailwind and maybe a headwind depending on which side of this balance wins out. In Europe, it's unmistakable. They would like to spend a bunch more money. And we see it in ECB policy expectations. I mean, we dramatically moved on what ECB policy is expected to be today, ahead of an ECB meeting, by the way, when the markets shouldn't want to have conviction. They should want to get to the other side of the event risk to make up their mind. Not today. Not today. The front run has been huge. We went from 80 basis points expected out of the ECB this year to now more like 60. A massive, massive rethink. So, and next year we're starting to flirt with the idea of hikes. There's a hike that's about a 50-50 chance next year for Europe now. And the ECB hasn't even met yet. So,
so you think the euro could take a run back into 110, 120? I mean, you think the euro could go really
totally. I wouldn't really start to get worried about the euro getting top heavy until we're back to 113.
Back to 113, 6 cents, 5 cents, Mr. Spivak. That's not small peanuts in the currency world. I mean, we've also done. We're up 4 cents in the euro the last 2 days.
Yeah.
I think, I've been reviewing this. I bring up this whole European spending thing, not just because of the euro here, but right, like the prediction that I laid out was the European equities would be hurt because they're going to have to make a trade-off here. And I think what makes me wrong, they're not making a trade-off. They're removing the debt brake. That's such a important.
What do you mean they're removing the debt brake?
Ilya?
in Germany, in the wake of the historical scars of hyperinflation, there is a debt break. Now,
Meaning a
obviously,
leverage limit?
meaning the government is not allowed to spend money past a very, very low ceiling on how much of a fiscal deficit you're allowed to run. That has been an appalling headwind for Germany over recent years. It's kept them from modernizing. It's kept them from really doing the things needed to get the economy to grow better, more, and most importantly, more efficiently. I mean, if we think our government in the U.S. is creaking along, the situation in Germany, sort of the bureaucratic state of affairs in Germany and how slow public services work and the government works, it is in a different decade, if not a different several decades, and needs massive revamp, and hasn't been able to do that because they have this break on spending. And so they've been arguing back and forth as to whether they should relax it. We just had an election in Germany. We have a new chancellor coming in. He's already struck a deal with the SPD, the Social Democrats. He's just defeated in the election. They're going to have a grand coalition. They're going to hold the AfD out of power. And they've already agreed that they're going to spend a bunch of money and they're going to let this debt break go. They're going to amend the Constitution to suspend it so that they can go and spend a bunch of dollars on all, or a bunch of euros, as it were, on all kinds of defense stuff. At the same time, obviously, there's the Stability and Growth Pact in the Eurozone, which tells them you have to keep deficits within, if memory serves, 3.5%. You've already seen the European Commission come out and say, yeah, not on this, though. And Commission President Ursula von der Leyen out here saying we're going to spend 800 billion euro on defense, and for the governments that don't have it, we're going to give them the money as preferential loans, raising it by selling euro bonds in the open market. That's a very different fiscal perspective in Europe. They've basically said, forget debt breaks. We're going to borrow. And by the way, there is no trade-off, Chris, because if the U.S. is less reliable of a borrower because the markets are afraid it is being erratic, you know who isn't being erratic? Let's go buy some European assets on the cheap. They're going to be able to sell these bonds like hotcakes, I suspect.
So does that mean that you think the yield spike is too much? And that mean that would, if we buy into the Europe is now the stable borrower, or predictable policy world,
it's just a more attractive one incrementally, near term. I don't think the U.S. has lost its dominance by any stretch.
Doesn't that also cap the euro a little bit? And
not for a long time yet.
Yeah, I mean, like it's so difficult to argue that the euro is where Europe's moving into safe haven territory. It looks relatively more appealing right now, and I think the performance of these various stock markets says all that you need to know. But, you know, in exploring why the thesis went off the rails, it's because there has been a new variable in play here, which is to say that the debt break being removed shows there is a fundamental change in European thought, and they're no longer holding themselves to austerity because guess what? They don't need to worry about their defense. They can just hang on to the security umbrella provided and afforded by the United States. So doing so, I mean, yeah, I guess the next question is, can Europe become a safe haven of sorts and replace the United States in that role, the dollar as a safe haven or global reserve currency? Probably not, given the myriad problems that remain. You know, we do see that outside of Germany, right, there are sovereign debt limits for the EU, broadly speaking, on an individual sovereign basis. And we talk about the German bund yield shooting up today and helping the euro. Yields across Europe went up today. And so it's becoming more costly for those governments to finance and service that debt. We have a stifling regulatory apparatus, high youth unemployment, energy dependency. Maybe they're trying to stop the industrialization. And it seems like they're going to try to keep fighting this war. it seems like they're getting ready to make sure that there's no more war, peace through strength, of course. But in the short term, if the U.S. pulls back, the U.S. has stopped today providing intelligence reports to Kyiv on incoming Russian missiles to civilian centers. Who's going to fill that gap? Europe seems like it's trying to step up to the plate in the short term. I don't know if there's a trade for the British pound in there, but the UK seems to be avoiding all of the noise and hatred throughout all this. The ire is directed at Canada, at Europe, broadly speaking. So the pound's doing quite well. Ilya,
and the UK is on board. I mean, it was Keir Starmer that was the place where Zelensky went after that blow up in the White House. He hosted the summit of all European leadership. He's been saying that he'd like to cultivate a closer relationship post-Brexit with the continent again. It seems like the UK and the European Union are very much on the same wavelength here. So the pound is rallying right alongside the euro because they're going to have to spend a bunch on defense too.
How's the vibe over in Europe, Dylan? I think that's actually a really important question because the business community here in the United States seems to be.
I think it's serious. I would say the vibe here is serious business, but I think it is what I mean when I say serious business. It is exactly what the German headlines: biggest move in the bond market since the Berlin Wall fell down. Europe is on its own. America is not an ally, and also Europe is basically not just going to lie down. They're not just going to lie down and be like, oh, well, we're so weak, we can't do anything. They may not succeed, but their attitude is, okay, we need to get our shit together, and we're $1 trillion up, and we're going to do it. And if it means that borrowing, if it means all these repricing of things, that's what it means. But we're not just going to roll over like a half-dead frog just because of Donald Trump or America is no longer our friend. I mean, my sense is that Europe is saying, and Germany for sure is saying, okay, let's figure it out.
Yeah.
But it doesn't seem angry. It doesn't seem sad. It just seems serious. Like if you're in a serious situation where you have serious risk and serious consequences, you have 500 million people, more people than America. You better get organized. If you don't get organized now, it's not going to be so much fun later.
The runway is running out to get your stuff together.
It's now or never. It's now or never. And I don't mean that like it's there's years to do this, but this is the generation that must transition. That there was 1945 to 1989, with obviously gradients within that domain, plenty of them, and then there was 1989 until 2025, chapter 2, and now chapter 3. 2025 until ...
So we talk about Trump perhaps trying to incentivize people here. I think this perhaps adds a little bit of color. Is he trying to incentivize Europe to get its act together, or does he really want to pull back from Europe? There was something of note. The $53 billion reconstruction plan proposed by Egypt for Gaza was rejected by the U.S. and Israel today. So Donald Trump still wants to go ahead and transform Gaza into the Riviera of the Middle East. He doesn't want other people's money. He's not saying this just to get other people to come to the table. They really want to do it his way. So this could be a sincere pullback from Europe. I suppose we need to wait to see if we close down like Ramstein Air Base or anything in Germany to really see where the ball's going. But it's a new opportunity then, right? We're in a different world. And we're in a different world where the U.S. markets right now, after outperforming for so long, I myself as the resident perma bear, right, Ilya, have been saying for so long that, the U.S., where else are you going to put your money? Europe's in deindustrializing, Brexit in the UK, Japan is Japan, South Korea is South Korea. But now all these countries are not acting that way anymore. They're acting like countries that can use their balance sheets, that can make government investment into critical industries. And that means a lot of these companies with valuations and stock prices that have been depressed because of a lack of curation by public resources to help seed the ground, a fertile environment for private business to flourish. That's turned the corner in a dramatic way. Whether or not you like it, that's just where the world is right now. So I look at what's happening in the United States, and I can't help but see these are two sides of the same puzzle right now. European stocks are soaring. U.S. stocks are struggling. It feels like allocation is moving to, again, where's there a bottleneck? Well, we're loosening government spending here, right? We're being told we're going to pull it back. Republican budget considering resolution aside, we keep hearing about balanced budgets, all right? And in Europe, they're opening the spigot for the first time. Rates have come down in Europe, as you know, Ilya. And so lower rates coupled with now a lot of fiscal spending, that is something that typically helps asset prices. If this was happening in the U.S. and the U.S. was seeing new spending plans coupled with a central bank tomorrow that's going to cut rates again, perhaps, and yeah, it could be the end of the road, but they're going to cut. That's going to be asset inflationary in the short term when these things materialize out of thin air. So this is one of the reasons why I have some hesitation here in our lovely S&P 500. I'd like to see them move back above the 1 week in both ES and NQ before I engage and take a swing off these lows. We're not there quite yet.
That's right. I mean, if ever there was a motivating reason to say things outside of the US and in particular in liquid Europe have been underperforming, and now you have a catalyst for them to catch up, here we are.
It's a new world. It's a new world. Same world for gold, though. Back into the midpoint of its recent trading range, not quite scaling 29.30, Ilya. Yesterday, you were talking about on that 4-hour chart when Westwater was here, how we can't quite just punch through the underside of the previous trading range yet. But no such problem for silver today, up 2.64%. No such problem for copper today, up a surging 5.43%. Square the circle for me. Copper's up, oil's down. Which one is correct? Ilya, you're first.
I think if you look at what copper's doing here, you're just really oscillating to the top of the range. And given the sort of story you're hearing from China and the impetus that you pointed out earlier that you see in, let's say, something like an FXI, maybe that's helpful here. I don't think that it's actionable in terms of a buying opportunity because you're right near the high, and so, or at least the closing high, and so the risk reward is off. It's a similar story in oil, only on the flip side. So neither of these things look like a tradable opportunity to me, but my skepticism of China's ability to get this right is greater than my confidence in a weaker demand, greater supply story for oil. I'm inclined to think oil is the correct one.
Which one's correct, Mr. Radigan, oil or copper?
Oil. Oil for sure.
You guys want
and not just because of the economic variable, because I think oil is additionally benefits from the sort of the peace movement, if you want to call it that.
So you guys want a bit of conspiracy, some tomorrow's news today. I was looking through the Doge tracker earlier, as one typically does. There are different websites out there that are doing this. Polymarket's doing it. There is dogetracker.com. Apparently, the U.S. government has found $105 billion of fraud, waste, and abuse in the system, which I think everyone's happy about, right? We don't want our taxpayer dollars going to waste. I'm going to tell you why we care about this. The GOP's House Appropriations bill that's going through is going to add $350 billion to the deficit in the forthcoming year. I will place a bet with someone if someone wants to create a market for me. When this number crosses the threshold for what the GOP House deficit will be, Elon Musk will come out and say that they've made a balanced budget. because they've saved taxpayers enough money through Doge to offset the increase in deficit spending that we have. And we're going to have a whole market reaction to whether or not this new math and accounting is actually the way that we should be conducting business here, because apparently GDP's a Keynesian devil hidden in plain sight, Mr. Spivak. But we have to get to that tomorrow because overtime is out of time for this Wednesday, March 5th, 2025. We'll be back same time, same place, right after our last call, 4 p.m. Eastern, 3 Central. So for Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. Good luck trading. Come back, though. Tasty Live continues after a brief break. It's Ilya Spivak with Macro Money up next.
See you there, everybody.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at Tasty Live.
If you missed the live show, here's our cherry on top.
Did I see a birthing room?
Birthing room?
Oh, stop. Please
behind
stop.
JJ, is there a birthing room?
That's not a birthing room, you genius. Okay. Oh my God. Yeah, we have a whole birthing room. It's called, oh my God, I think it's called a lactation room. Okay.
No, we have a birthing room. Hey, Tasty, we're delivering babies.
Got the need for speed? No problem. At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
In the world of options, somebody once said, for every gimme, there's a gotcha.
It's all about generating positive expectancy in your portfolio.
Welcome to Option Trades Today. I'm Tony the Bat Batiste, and I've got not one, but 2 trade ideas for you today.
Exploring zero DTE. We promised you we would take a look, and here we go.
The beauty of Thinkorswim was that we were different.
From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building. The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing. Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts. Some people say it's insane. That's what I do.
It is the biggest move for European bond markets since the 1990s. That's what we're going to figure out here today. An absolutely crazy day for the markets around some of the news we've seen of all places coming out of Washington, D.C. and the reaction to it. I'm going to figure out what that has to do with the euro and why it has been an absolutely explosive market in the past 48 hours. This is Ilya Spivak, head of Global Macro here at Tasty Live, and you're watching Macro Money. The headlines are coming fast and furious here, but the conversation to be had about stock markets hasn't really changed in a very dramatic way. The Wall Street response to all of this has been somewhat tepid. We've kind of come off the lows of recession fears over the past day or so, but that does not change what has been the really big impetus for these markets, and that's really the situation happening in Europe. So let's take a look at first what is going on against that backdrop, and then, of course, likewise, take a look at how all of this lines up with what is the next big influence for event risk, pertinent as it is, of course, the ECB monetary policy announcement, which comes at us in just mere hours. So the first thing to consider here, the price action itself. The move in the euro has been absolutely staggering. In fact, over the past 2 days, we have a rally of nearly 3%, which for currency markets, liquid and relatively constrained, though they are relative to others because of that liquidity, is an absolutely enormous move. In fact, this is the largest 2-day euro rally since November of 2022. What is motivating it? Well, we've talked at length on this show, and certainly updated on this last week, that the main driver has been, we can clearly see it here, the spread between German and U.S. 2-year yields. Put another way, however the relative power balance or the relative yield advantage balance looks at the front end of the yield curve, Europe versus the Fed, that's what you see in the euro. So when you get the Fed coming out and sounding very dovish, and the market says, whoa, that's too dovish, you're not going to do all these rate cuts, hold on, in September, there is a shift higher in U.S. yields. We, of course, see it with a massive sell-off in the U.S. Treasury bond market, in a rally across the yield curve from September just up to mid-December and into the beginning of this year. And of course, in parallel, you get a strong U.S. dollar rally as the U.S. yield advantage expands. But since then, you can clearly see we've started to move the other way. And over the past 2 days, that move the other way has really gained a tremendous amount of traction. Ostensibly, this had to do last week, to the past 48 hours, with the idea that we've had relative stasis in Eurozone monetary policy expectations. We'll take a look at those in just a second, but the outlook for the ECB was mainly looked anchored. At the same time that the story for the Fed was becoming less hawkish as soft U.S. economic data began to signal that maybe the Fed is going to have to do more easing than the markets were anticipating. As a matter of fact, looking at U.S. policy expectations since that fateful day on February the 21st, when we got that U.S. PMI data showing an absolutely eye-watering slowdown in the service sector. It wasn't quite the contraction initially reported, as we learned today. The revised set of numbers came out today and showed that no, the U.S. service sector ultimately did not contract in February. It did manage growth, but it was a very slow rate of growth. And it turned out that on the whole, when we look at just how much growth we ended up with sort of relative to history, it was the weakest since April of last year. So we're looking at a situation here that's not altogether supportive for U.S. yields going much higher. At the same time, those in Europe are holding up, and so the yield spread kind of starts to shift in the euro's favor. But boy, has it picked up steam. We can see it in these absolutely record-breaking moves here. And in the blue, what you see is Germany's 10-year yield. In the magenta is the corresponding bond. So you can see here the bonds, again, in the blue is the note, in the magenta, the yield. The note absolutely falling apart here. This is, in fact, the biggest sell-off in German bonds that we have seen in, just about 3 decades, give or take. And the impetus could not be more powerful, it would seem, on the euro. Why are we seeing this? Well, clearly there has been something of a geopolitical reshuffle that has gained momentum. Over the past day, we've seen that in the wake of last week's very tense exchange, let's call it, between embattled Ukrainian President Volodymyr Zelensky and U.S. President Donald Trump and Vice President J.D. Vance. In the aftermath of that, it clearly seemed like things were starting to gain some momentum toward a reorientation. But subsequently, the U.S. has moved to stop military aid, or to pause military aid to Ukraine, and to pause intelligence sharing too. That has really crystallized for Europe, it would seem. Of course, after Zelensky had that meeting, he promptly went to London for a meeting with UK Prime Minister Keir Starmer, as well as all of the continental European leadership. And the outcome has been that Europe has seemingly decided that it can no longer just rely on an American security guarantee, that it needs to dramatically rearm. News out of the European Commission, the president there, Ursula von der Leyen, saying that the region has agreed to look the other way on its own debt limits, to announce an $800 billion or 800 billion euro, some $840 billion package on defense spending. And at the same time, the incoming German Chancellor, Friedrich Merz, who just won the election, about 2 weeks ago, he has already reached a pact with rival SPD, Social Democrats for a Grand Coalition, and they've already agreed to suspend that country's even more restrictive debt brake to boost defense spending. Now, that's a whole lot of money flowing through fiscal spending into the regional economy. Not surprisingly, that's something that might be reflected in higher inflation, and you can see it in German break-even rates across the board. Just a brief reminder here, these are the measures of implied inflation expectations in the bond market as reflected by taking the difference between nominal bond yields and inflation-adjusted or real, as it were, bond yields. When you take that difference, you end up with the inflation adjustment that it takes to go from nominal to real. It tells you what the bond market thinks about where inflation is going. Well, here we are. Clearly, over the past several sessions here, we've had a dramatic upshift in Eurozone inflation expectations across maturities, not just the front end here in the red, but all the way out to the 20-year spread. All the way up here, everything is showing a massive shift in inflation expectations, and that, of course, giving us this massive upshift in rates. You can see it in ECB policy expectations too. And that, of course, is what is particularly in focus here as the ECB gets ready for a policy meeting. Now, we can see currently the deposit rate 2.75%, and for this March meeting, a rate cut is still all the way priced in. You're looking at 2.5. That much is probably not going to be a headwind for the euro because the markets have already discounted it, and in fact have discounted it for quite some time. We can see that these curves have not shifted very much at all on this question, going all the way back to October. So October, December, the January meeting, and now ahead of this one, all of these curves had rates at about 2.5% at the March meeting. So this rate cut is going forward, and it's been in the market for a long time. The larger question is what has happened with the direction of travel for the curve. And of course, we can see with this surge in rates, the curve has become much flatter. So the end point for the end of this year has now clawed back over the 2% line. And we can see clearly we're looking at the least dovish curve that we've seen out of this from basically the past 4 meetings. That is not quite telling the whole story. The move has actually been much more dramatic than it appears. And when we look at these sum totals for what's occurred, you start to really see it. At this point, we are only expecting 56 basis points in net rate cuts this year and next from the ECB. That is a dramatic rethink of what is going on. If you took a look at this just yesterday, that tally wasn't 56, it was 86, veering on 87. So what we've done here is essentially moved for the entirety of the outlook this year and next by a cumulative 30 basis points. That's a very big shift, and you can clearly see it in this dramatic jump in the orange line. For this year, the outlook has moved pretty significantly as well, from 88 basis points being baked in for easing this year, so erring on the side of 4 rate cuts, to now one of those cuts falling away. About 19 basis points gone out of this year's outlook, and we're down to just 69, maybe 70 basis points. So 2 cuts and a strong leaning toward a third. Moreover, the outlook for next year is starting to look like maybe we're going to start to see already a pivot in the other direction. So 14 basis points being baked in there, that's about a 56% chance, so a little bit better than even, of a rate hike of 25 basis points next year. So the situation has dramatically changed. Now, why are we so relatively stayed here? Well, at this point, as we mentioned, the reason why we got this shift already starting to happen before this surge is because ECB policy expectations have been relatively anchored, and it's the U.S. side that's gotten more dovish on the other end of the spectrum. And so we've had a shift that's been mainly U.S. driven. Now, of course, we're getting a shift that's not just U.S., but also Euro driven in the same direction. The reason why things were relatively stayed in Europe is they've been trying to figure out how to reconcile cooling growth and sticky inflation. In fact, we just saw updated Eurozone CPI numbers this week. They came in a little bit warmer than anticipated, 2.4% versus 2.3% expected. And if we look at the breakdown for what's been happening, we don't quite have the January numbers yet. They don't release that breakdown when they publish the early estimate of CPI that we got this week. But we can look back to December, and we can clearly see here still the trouble that the ECB finds themselves facing. The lion's share of inflation, in fact, the thing keeping the ECB from its target, is this stickiness in restaurants, hotels, essentially the hospitality sector. Take away that 0.5 percentage point, and you've got this thing down to 1.9%. But clearly, this has remained a sticky part of the equation. Influences from the energy side of things have come and gone, and that's actually explaining what's going on here. This is fuel costs. When you look at what's been the uplift in the miscellaneous component, it's been mainly insurance and mainly for vehicles. So that's a knock-on effect from what's going on here. Same thing for costs of transport. So all of this seemingly coming down to autos for the uplift, and that's come and it's gone, and now it's come again. This has been relatively sticky. And of course, the problem with it being sticky is that against this backdrop, the economy has been relatively anemic. We got a little bit of a revision in the PMIs that just was published today, the final versions of these numbers, but they don't really change the bottom line. The manufacturing sector continues to be in contraction mode. That may change with all of these defense spending outlays, but so far, anyway, the manufacturing sector below that 50 boom-bust level for the PMIs that separates contraction from expansion. We can see, of course, the pace of contraction has eased a little bit recently, but nevertheless, we're below 50, so manufacturing is contracting. Services has slumped down to basically standstill. It's hugging that 50 line after 2 months of slowdown. The composite index taking in both, given how much services outweighs manufacturing in the total, looks like it's following the service sector, much as it does for most major economies. And so we are hugging neutral. We're hugging standstill on growth indications. So the ECB is a bit stuck before you have today's moves and yesterday's moves. It's a bit stuck because it can't really cut any more to boost this growth situation while inflation is going the wrong way. And of course, that slower economic conditions aren't bringing down inflation in what you'd think is a fairly discretionary spending, cyclically sensitive kind of a sector like hospitality. Tells you there's not an easy path into a trade-off here for the ECB. It's not easy for them to say, well, growth is slowing, so hospitality and hotels will disinflate because it's discretionary spending and the slowdown will take care of it. We have the room to start to cut a little bit more aggressively to boost the economy. Well, even before these latest moves, that was a tough sell. So the euro already was in a position where the outlook looked fairly anchored, and the rate cut was probably not going to be that much of a headwind for the euro. But what we now have is much more dramatic. Not only do you have this sticky inflation, but again, looking back at these break-even rates, now inflation expectations are dramatically marching higher, because if Europe is going to spend all this additional money on defense, then you probably have a whole lot more of a fiscal impetus toward inflation, and that's how you end up with the kind of rejiggering of the overall path for interest rates that you see here. That's how you start to shave away 30 basis points from the outlook. And then, of course, you're going to want to hear what ECB President Christine Lagarde says. Because if the rate cut is fully baked in, as we've seen already, there it is, then the larger question is, does the central bank, after the governing council's meeting, give you some sort of an indication that it is going to cut its cycle short, and this curve then perhaps is going to get something of a kink in it, where the long end starts to move higher, or perhaps we even just flatten out a bit more and go from the 70 basis points that are already on the menu for this year to a little bit less. But the impetus here for the ECB to jump out the window seems relatively low. Changing course and complicating fundraising efforts for regional governments at a time when they need to borrow a bunch of money to do all this spending probably isn't the likely next step. As long as CPI doesn't start to dramatically run away from target, the ECB probably has room to sit on its hands and do relatively little. So, if we're not going to get a more hawkish ECB, that seems unlikely, to say the least. If you're not going to get a more dovish ECB, then the meeting just represents event risk. With that in mind, looking back at the euro, now that you've hit 108 as an important inflection point here, we can see it's been acting as support, then resistance, then support, then resistance, now resistance again. Now that you've hit this barrier, you might see a bit of a pullback into the ECB just because the markets don't want to be tilted too far on one side or the other ahead of major event risk. They clearly have already front-run the central bank by a big margin here with this move, just slicing through former support, now acting as resistance here at the mid-106s and 107. So maybe you get a pullback here a little bit over the coming hours until you get the ECB. Maybe that then gives you a tradable bottom from which to look for a long position at better levels. In any case, the risk reward to chasing this long now looking fairly shot as you're pushing nose up against this key barrier. So from a trading perspective, all of the ingredients for euro gains seem to be on the board. From a price action perspective, you probably have a bit of room for a tactical pullback or at least a confirmed close through this immediate resistance as the possible scenarios to start to think about how to be a buyer in this market. And if, of course, you're not a buyer already. And that's where the ECB opportunity lies, in that you have major event risk. You maybe have the opportunity for a little bit of a mulligan, a little bit of a pullback to look for an attractive place to capture this larger shift in the European macro backdrop. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow. I am likewise on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Good luck out there.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than, boom, trade like a trader. Tasty Trade. Make your move.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
In the money. It seems pretty easy to understand. If I'm in the money, I must be profitable, right? Not quite. In the money is in reference to the option's strike price relative to the current price of the stock. An in the money option is an option which has intrinsic value. For a call option, that represents an option with a strike lower than the current stock price. For a put option, that represents an option with a strike higher than the current stock price. Being in the money is a good thing for long options. It's not so good for short options.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace. With me today, it's Wednesday, of course, Shelly Van.
Hello, hello.
How are you?
Doing all right. How about you?
I'm good. Yeah. Can't complain. Usually I'm able to find something to complain about, but we can complain about the weather any day here in the winter in Chicago. But other than that, I'm good.
Sounds good.
Yeah, I'm feeling better. Bitcoin over 90. That's about all it takes for me.
Right.
Yeah, Bitcoin over 90. Everything's great.
That's cool.
Yeah, nothing else is a problem whatsoever. Everything's good. How are you doing? Aside from, lots going on at work here today, but beans. We've got to keep pumping it. I know that we've got growing viewership. I'm sure, hopefully, we've got some people coming over to this show as well.
Yeah, actually, some friends in chat have joined and won prizes. And so, Sophos, Frank, get in the Discord because we have questions for you. We need to know wallet addresses, things like that, so that we can send giveaway prizes accordingly.
Go get that money, Lone Sophos and Frank. Question for the chat today. I guess, first of all, if you aren't streaming this on YouTube and in the chat and typing just crazy shit and speaking your mind in here, what are you doing? Get over to the chat. Mm-hmm. Shelly, what's the question of the day?
Pet peeve.
Ooh, okay.
Yeah. What do you got?
Oh, where to start? I mean, this is one that probably is I don't know if it's a pet peeve or just like, everybody hates this. When you're eating food or you're eating with someone and they are scraping their fork or spoon or whatever, just it's hitting the plate.
Yeah. The
Yes.
cutting a steak on a porcelain dish.
Yeah. I mean, I guess like, oh, wow, Ryan pulled out nails on a chalkboard. That's his pet peeve. Very original.
That was specific, though. That counts.
How about yourself?
I have quite a few. Recently, though, I have a sunrise alarm clock. It's beautiful. I set, if I set my alarm for 5 a.m. at 4:30, it very slowly lights up my room.
Okay, I was going to ask what a sunrise alarm clock is, but that makes sense.
It's magnificent, especially during these hours when you wake up and it's pitch black. It kind of just, the natural circadian rhythm is activated. Well, mine's glitched, and the sun is rising at like 2 a.m. So I'm going to call that my pet peeve because I've been very tired. And I'm like, why? What's happening? And then I'm like, at 2 a.m., I woke up and I was like, why is the sun out? So, yeah.
So it's like a one-time occurrence, or what's the deal here? Are you going to unplug it tonight, or?
Oh, it's
okay.
It's happening tonight. There's going to be a whole fight.
I can see how that's annoying. Yeah. I've got another one. Just came to mind. I haven't experienced this recently, but if you're on public transportation, usually you do.
Ooh.
When people are playing video games or TikTok videos or whatever on max volume on their phones with no headphones and no awareness, clearly. Pet peeve.
Yep. Well, we could do this all day because now I had just 4 more come funneling in.
Just generally.
I want to know in chat, what are your pet peeves? Well, in Sophos, someone talking over me when I'm speaking or interrupting me. That'll just rudeness, I think, is totally fair. Grumpy Mike, raining here. Uh-oh, it's Shelly Van. Why uh-oh?
I think it's like a good no, like, yo! It's Shelly Van, yeah. I think at least that's how I interpreted it, right, Grumpy Mike?
Yeah, go with it. Jose!
Wherever Grumpy Mike's at, I don't know, is Grumpy Mike in Hawaii or something? Second time this year?
Well,
as in like 60-some days in, you've had rain twice?
In Hawaii?
I don't know where he is, but what the hell?
I was going to say, it rains like every day in Hawaii, unless you're on like the Kona side.
Yeah, I've never been, so I don't really know what you're referring to, but it sounds nice.
Yeah, oh yeah. Recommended.
Shelly, let's jump into the show. We've got a lot to talk about here today, specific to some of the things that we're doing on the Tasty Trade side of the business. We're associated with crypto, so we're going to talk about all areas of the crypto offering, whether it's Tasty Crypto, it's Tasty Trade, or here on Tasty Live, the crypto content. But I want to discuss the new tokens that we've added to the platform.
I love them.
5 more. I think it takes the offering to maybe 12. We've got another 5 coming. If people have demand for other tokens, other coins, let us know what you'd like to see on the platform, and we'll do our best to get it up and running ASAP. But let's talk about the 5 that we added this week. Shiba Inu, Cardano, Aave, Avalanche, Chainlink.
Well done.
Do you own any of these?
5 for 5.
You own them all?
I do.
I should have known.
Across a few wallets. I'm interested to learn about them from you, though, because I will admit, in my AP ways, I just bought in early, and they sit in my wallet.
That's okay. I can respect that approach. You've got to have a little skin in the game. You then have an incentive to learn a little bit more about these. I don't know how relevant or necessary that is in crypto at times. I mean, I suppose that's also applicable to the stock market. You don't really need to know what you own, but you maybe should. That's some people's advice, at least. But I commend you jumping in head first, all 5. I don't own any of these presently, but in the past I have been trading around in some of these, and I've had a Chainlink position for a long time, but I did sell out of it as we got this recent rally. I don't know when it was. I've probably been out of it for a few months, but once we finally just got off of those lows that we were in for some time, I was able to take some positions off the table and consolidate a little bit. But who cares about me? Let's talk about these tokens, Shelly. Start with Cardano because I believe, and we'll get to just a comparison around market cap and performance here in a second, but I think this is the biggest one by market cap that's on the list of these 5. You want to take this one? You want me to take this one?
You take it because I'm realizing I have to look way over here to see.
Oh, okay. You only have the live stream up there. Okay. Ticker, A, D as in dog. A, again, as in apple. Cardano is a proof-of-stake blockchain. It's created by Charles Hoskinson, and he was one of the co-founders of Ethereum. I don't trade this. I mean, I have nothing against it, right? Sometimes people think that, oh, you don't own it, you must hate it, in crypto at least. Not the case. We'll probably get into this, and certainly now that it's at tastytrade, definitely on the radar. We will put expected moves and the performance dashboard pieces in place around this as well. I think of this as Ethereum. When you just do a quick search, you look at the description in the Tasty, through CoinMarketCap. It's not in the Tasty Crypto app yet, is on tastytrade. But when you look at the description, you'll find that this is, focused on being environmentally sustainable. It's a proof of stake blockchain. The initial objective was to improve on some of the functionality that exists with Bitcoin and Ethereum. Like many other networks, you can transfer tokens across it. ADA is the native cryptocurrency to the chain. And this is one that, from what I've seen anecdotally, a lot of people are interested in. There's a lot of demand for. I'm not quite sure, where the activity is when we look at this from the fundamental perspective that supports it. So we can do a deep dive on this later. But high level, this is what
music NFTs on Cardano.
You do.
I do.
Oh, awesome. Okay.
Yeah. This was a couple of years ago, but it's all coming back to me now because I have an artist friend who's like super Cardano maxi. And I remember it was a little confusing to get them at the time. Once I had them, I was like, well, that was interesting. It was cheaper than ETH, basically.
This is done well recently, given going back to the tweet over the weekend. We still call them tweets, right? Even though it's X.
I do.
Yeah, I do too. It's going to be hard to shake that. I don't know what else you would post.
Well, they're called posts, but that
post on X. Cool. The tweet over the weekend from President Trump did mention ADA as one of the assets potentially included in a digital asset strategic reserve of the United States. And so, like the others, this has exploded higher in price. I just want to get a quote really quickly. 98 cents. So just a couple of days ago, it was about 60 cents or so. So nice move to the upside. It has pulled back a little bit, but it's topped out at about 120. So a nice 100% move on that tweet. Still up about 44% on the week. So keep an eye on it. I've got it on the watch list. It's now in the tastytrade platform, but let's move on to some of the other offerings. The next one being Shiba Inu. How would you say it when you just see the ticker? Shib. But Shiba Inu.
Sheeb.
Another cute little dog.
Mm-hmm. We like our dogs.
Shiba Inu is a token on the Ethereum network. So this is an ERC20 token that has also become a popular meme coin like Doge. I think of this as like the Ethereum version of Doge. Doge is obviously its own chain. This is a meme on Ethereum. And there's a lot going on here. We're not going to break down every element to the communities behind this, but you hear meme and you kind of just think, oh, it's just speculative. But there's actually a lot behind this. A little bit of backstory first, though. This was originally something where, well, you can see it here on the screen, 1 quadrillion tokens were minted. So basically unlimited supply, similar to Doge and many others, and a significant portion of it was then sent to Vitalik Buterin. That said, he burned 90% of what he received, and then he donated the rest to charity. So there's not quite 1 quadrillion tokens anymore.
There's also the layer 2 network on SHIB. That's the Shibarium.
Okay.
I'm not super familiar with it, but I like the sound of it.
I think I have that in my notes if I can find it here. I mean, there is an ecosystem to this. So you have Shiba Swap, decentralized exchange. You've got Bone, Shiba Swap, and Leash. These are other tokens that are associated with the Shiba Inu ecosystem. Bone, for instance, is used for voting in the decentralized Shiba Inu's Doggy DAO.
Mm-hmm. This is real life, people.
I used to have an opinion on like interest rates and Federal Reserve monetary policy and big macro trades, and the Doggy DAO is my thing now.
Yep.
I love it though. You can trade Shiba Inu now at Tasty Trade, which is exciting because I think when you look at memes, you know, we've made this argument before. There is a place in the portfolio, specifically in bull markets, where you want that volatility exposure. And as much as we joke about this, I think it's still true today. We'll have to run the numbers, but I believe the best performing crypto asset is still Dogecoin, outperforming Bitcoin. You're going to live by that volatility and experience it on the downside as well. But even in the last year, Doge is up 11% still, up hundreds of percentage points at one point in time. So we joke about the memes, but I do believe there is a place in the portfolio for them.
Memes don't take offense.
No. Got to be able to stomach the volatility, though. All right, next on the list, Chainlink. Arguably a little bit more of a fundamental use case here and an investment case as well. Chainlink, if you're not familiar with it, is a decentralized Oracle network that provides data to smart contracts. Now, this is very important if we believe that smart contracts and blockchain networks are going to power more things in the future, even beyond financial use cases. So with smart contracts in this scenario, or if we think about the growth here, there's going to be an increased need for external data to be fed on chain, right? Obviously, you can reference prices, you can reference on-chain data, but you need to also be able to, in many cases, reference in a secure manner off-chain data. Maybe that's just the temperature outside. But all of these things that exist in the real world, you want to be able to reference so that smart contracts can function as a result. Chainlink solves this problem by allowing smart contracts to securely interact with external data feeds such as APIs, and you can also think about it as databases in the traditional sense when we look at bank payments, other centralized databases. And I see in the chat, great comment, Pyth is a strong competitor to Link as well. Yes, there are more than one. There's more than one Oracle solution out there. Chainlink is probably one of the better known ones at this point.
Can I ask you just a sidebar question relating to smart contracts? What do you think the future holds for smart contracts? In terms that right now, I think NFTs gave sort of a really... They gave smart contracts a bad name, in my opinion, because everybody focused on the JPEG instead of the underlying technology, which is the smart contract. So I'm just curious, take off the JPEG and get that out of our heads. Smart contracts.
Yeah, I mean, I think it's the foundation or the core to, obviously, applications, decentralized applications that run on blockchain networks. I mean, this is just code on chain. It's, again, the basis for building applications on these networks. I think becomes more and more relevant when we layer on top of it this AI component. If you believe that there's going to be this continued proliferation of AI, which I don't think there's any reason not to believe that, then more complex smart contracts are going to facilitate more processes and add more value, more utility, if that makes sense. Today we think about smart contract interactions where I might trade through a decentralized exchange. So that's going to use, obviously, smart contracts. But when we think about, some of the processes that exist when we look at the real world, real business cases, how businesses engage or interact with one another, how supply chains are managed, et cetera, I think, I guess whether AI is involved or not, that's where these complex smart contracts play a much larger role in just kind of automating things.
Health insurance.
Yeah.
I want that so bad.
Yeah, it is. It is odd that your health records still kind of are stored like with your doctor, and then they have to send them to another doctor, and you don't really have ownership.
In 3 states in the last 3 years, I'm like a newborn.
Yeah.
They're like, what's your medical history? I'm like, what do I want it to be? Because
Right.
clearly you don't have any records.
So I think, yeah, blockchain in many ways helps to solve for that. But yeah, I think what you're going to see, and whether we think about what's happening at the contract level or not, it's going to be facilitated by smart contracts. So Chainlink is an oracle, and at the end of the day is, is going to play a role in terms of obviously feeds for various types of data, and how that data is referenced in order for different things to function on chain.
Can you define Oracle for anybody who doesn't fully understand what that is?
I just think of it as a data feed.
Yeah.
Yeah, that's kind of high level how I think about it. I don't know, is that like Greek mythology? Oracle, all-seeing, all-knowing.
I just think of the Matrix.
Yeah. But in this case, I just think about it as a data feed or a network of data feeds that can be referenced, and you can pull in or ingest data on chain that just otherwise doesn't exist on chain. Right? That blockchain doesn't know what the score of the baseball game was. But if you have an Oracle network that can take those prices or those values or that data and it can be referenced, then smart contracts can, I guess, function as a result, operate as a result.
So Flower Power 2222, how do you keep records private if the blockchain is public and accessible by everyone? Would an Oracle be a solution to that if there's a privacy layer to that data?
I think so. I mean, it's a good question. I don't think that while, things are transparent on chain, it doesn't mean that you couldn't have private blockchains where this could work. I don't know. I honestly don't know if anybody has solved for this yet, but just the concept of being able to own your own data and take that with you in the same way that you're the custodian of your assets on chain. I guess look at it this way. Sure, the data is transparent in some form. The wallet address, if we just look at it today, is transparent, and we do associate, these balances and these tokens with symbols, and we have a concept of a price and this kind of real-world approach to it. But it can be masked, right? Even when I think about a wallet address, unless you have a .eth or you've gone out there and you've associated or attached a name to it, it's just an address. I don't know your address.
Right.
And so I think there is some degree of privacy in that sense, but problems to solve for sure.
We're early.
Absolutely. Chainlink. Up next, Aave. Aave is DeFi. It's a lending platform built on the Ethereum blockchain, allows users to lend out their cryptocurrencies and earn interest on them or borrow against their crypto holdings by providing collateral. And if you've ever been on the Aave platform, it supports a wide range of cryptocurrencies for both lending and borrowing. Huge, huge use case, right? I mean, this is banking 101.
That's awesome.
Finally, Avalanche, ticker is AVAX. Avalanche is another blockchain network. It's a high-performance one, scalable blockchain platform designed for creating custom blockchain networks and decentralized applications. I'll be honest with you, I'm not super familiar with the intricacies or the inner workings of Avalanche, but what we have on the screen tells you that it consists of 3 built-in blockchains. You have the exchange or X chain, the platform chain, and the contract chain. And each chain then serves a distinct purpose, optimizing the network's overall performance and utility. So we just kind of have some words up here on the screen. But I think you have been involved with Avalanche to some extent, right?
Only because I like shopping for funny things to invest in. I did look on OpenSea because you can shop for Avalanche based NFTs on that platform. There aren't that many, just a few. But
there are these ones though.
Sausagers, villagers, but sausage. I mean,
I love them.
This is real life. You could own one of these or many of these if you wanted to. But you need the AVAX token.
Okay, so that is the underlying currency. And that's important that when we talk about a lot of these blockchain networks, they have an associated currency or cryptocurrency, the native
token. Yes.
And in this case, it's AVAX or AVAX.
Mm-hmm.
Okay. These aren't the ones that you own. These are just ones that are
I
for
was just
sale.
shopping because I was like, oh, interesting. These are hilarious.
So when you're shopping, what are you looking for specifically? Just kind of pops out at you?
Yeah.
Or are we going for one of these like leopard print sausages?
I kind of like the female ones.
Okay, yep.
Because the sausage with boobs is just, why not?
Yep.
Come on. Gotta have it.
Yeah,
that's how I shop. The funnier, the better. And it's culture on chain, Ryan. That's kind of my thing.
Now, I do have to call this one out. I mean, this one is a sausage with a baby while smoking a blunt or a cigar. I'm not quite sure what that is. I'm assuming it's a cigar, but could be something else. Crack pipe? I don't know. Sausage with a crack pipe and a baby. You can get it for 5 AVAX. Could be yours today.
Mm-hmm.
Oh, I do love this stuff. It's fun. Avalanche is, again, another blockchain network. There are a lot of these. I think over time, you probably see some degree of interoperability. There are different use cases for different chains. I think there's also an argument to be made that there is an excess of block space in some cases. And so when you think about how you value these things and you think about blockchains as security layers or the business being that you sell block space, well, there's seemingly a lot of block space. And, at times that's reflected in the price. There are, to an extent, as we've talked about, we wrote about this in the email over the weekend, there are fundamentals that you can track. And so if we just jump to the next slide here, just an objective look at where we are. I have no opinion on one versus the other. No one's here saying that, you should own Shiba Inu versus Aave. These are entirely different things. We're simply just expanding the available product offering at tastytrade. But Cardano is the largest by market cap. Aave is the smallest presently. And you can see some of these have done fairly well, while others, not so much. Shiba Inu, like many of the memes, is down significantly, but you can see this thing go up 100%. We do have volatilities when we look at ADA or Cardano of 231%. Now, that's a realized volatility on a 30-day basis. We just look at the 30-day realized vol and we annualize it. They can only go to 0, which would be a 100% vol. So when you have a 231% volatility, it means that this thing has, at times, experienced exponential asymmetric returns to the upside. And so very, very volatile. Be aware of that, I guess, if anything. But if you're looking for tokens that could potentially outperform in bull markets, then again, you want to own some of these things that have vols north of 100%, because in the event that they go up, they're going to go up a lot, but they can also go down by 100% as well. So keep that in mind.
And something like SHIB, you can get quite a lot for a very little bit.
Yeah. You can own hundreds of millions of Shiba Inu if you want.
Mm-hmm.
Given the initial supply of a quadrillion. Shelly, before we wrap things up, I've got to mention a new update to the tastytrade mobile application. Super excited about this. The team behind it has been hard at work for the last couple of months, and this is a huge change to the application. So if we could just quickly throw this up here on the screen, I've got the mobile app loaded up. If your tastytrade app doesn't look like this, we typically phase out the release update, but you can go directly to the iOS or Android store, the Google Play Store, and you can update this manually if your app doesn't look like it. But if we can throw the interface up here on the screen, we'll just take a look at this. Boom. So what we've done really quickly is if you start on your dashboard, you look down there at the bottom navigation menu, you'll now notice there is a separate crypto tab. When you click on that, you'll now see everything in one place, all the new tokens. If you don't have crypto trading enabled, which this account doesn't, you'll be able to quickly enable that. So you have to enable crypto trading for your cash or margin account with Zero Hash. That's the third-party service provider, the custodian of the crypto assets. And then you'll have everything right here. So this acts as both your launch pad for trading and also a watch list. I personally have never seen prices update this quickly. So that's one thing that I love about this, right? I use the Coinbase app. I use others. It's not a knock against them. They do many things well, but damn, this price feed is fast. And I mean, that's what you want, right? Fast prices updating in real time. So you can see the price change there, really like that. As you scroll down, you've got this content section here. So you can learn a little bit more about some of the tokens, about crypto, about Bitcoin, et cetera. And then if you want to trade the futures, you want to reference those prices. We've got that here on the screen. Got the ETFs as well. And clicking on any one of these is then going to bring up that trade ticket everybody's probably used to if they've used this app. And so when you click on that, that'll start that process and you can jump back there. A lot more coming, but this is phase one. Step one was released just yesterday. So if your app doesn't look like this and you haven't received the auto update just yet, you can manually update. Go to the iOS App Store, go to the Google Play Store, update your Tasty Trade app and get this brand new badass crypto interface.
Shout out to the teams.
Yes. Yeah, they did a fantastic job here. So I'm super excited about it. And the workflow in here, at least in terms of how I typically approach the market, this works really well for me. I love having everything in one place. You can jump to a trade. I could buy my $2 worth of ETH, and then I can jump back to the main screen. So I like it a lot. But yeah, as Jose is saying in the chat, and shout out to Jose, everything crypto related, all in one place. I got a ton of stuff that is coming to this as well. More improvements coming soon. And we've got a new update of the Tasty Crypto app that went to the store today. I think it's still in review. I haven't seen that it was approved yet, but we will demo that. A lot of new stuff in there as well. But that's going to do it for our show. 5 new tokens on the Tasty Trade platform, 5 more coming next week. We'll keep you up to date when those are live, and we'll talk through them as well. But Shelly, thank you for coming on the show. You'll be back on air on Friday with Dan for Beans. Check that out over on the Tasty Crypto Network, I suppose we can call it.
Ooh, yeah.
Tasty Crypto YouTube channel. If you're not a subscriber, get over there and hit that subscribe button.
Thank you. See you on Beans.
See you then. Until then, I'm Ryan.
Shelly.
Peace.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
In road trips, my family, it was like whoever could get the captain seat was it.
That's great. I'm having a great time.
Me too. But, I mean, stay a while. Take your jacket off.
No. I mean, I'll stay, but the jacket's not
Come
coming
on,
off.
take your jacket off.
Nope.
Come on,
No.
take it out.
I'm sorry. I didn't mean to.
No, I'm sorry.
You hopped on this cowboy's horse, so I guess you got to hear his tale. In '87, I took it off. There was the market crash. In '92, NBC canceled Blossom. A couple of years ago, I lost it for 2 days, and the Lakers won the NBA Finals. Bottom line is when this thing comes off, bad things happen.
You've got to take it off sometimes. I mean,
Never do.
how do you shower?
And the jacket's kind of gotten used to it. In fact, every few days it needs it.
No matter what, you keep it on.
I can take my shirt off if you want, but I'm not taking the jacket off.
I just don't know if that's something that I could deal with.
It'll be like a teal tornado. Just endlessly washing up on your short.
I mean,
This is moving so fast, and I like it.
Yeah.
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
In the world of options, somebody once said, for every gimme, there's a gotcha.
It's all about generating positive expectancy in your portfolio.
Welcome to Option Trades Today. I'm Tony the Bat Batiste, and I've got not one, but two trade ideas for you today.
Exploring zero DTE. We promised you we would take a look, and here we go.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Regulation time may have expired, but the conversation is just getting started. This is Overtime, the post-market scrimmage for market junkies. Join Chris Vecchio, Ilya Spivak, and me, Dylan Radigan, as we analyze the X's and O's for everything from earnings to politics to macro events and more. Nothing's out of bounds on Overtime. We break down the news to provide you a playbook for your trades. Watch Overtime Monday through Thursday only on tastylive.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts. Some people say it's insane. That's what I do.
Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Oh, yeah, it is Wednesday, March 5th, a little bit after 5 p.m. Central Time. The best time, you know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. It's Wacky Wednesday, everybody. You know what that means, an extra heavy dose of chest hair. What's going on, Christopher Vecchio? I got you. I got you.
And I know how to listen, and I know how to read. So we've checked two boxes here at the start of the show.
Let's step on anyone who's in Montessori school or sent their children to Montessori school. I visited one the other day. Have you visited a Montessori school? Are you going the Montessori route, or are you going to go the traditional, like Rothschild, Henry Ford, assembly line, traditional school type route? What are you doing with the children?
Given the direction of the country, I think she'll be working in a factory soon. So she has small hands that are very dexterous.
I visited a Montessori school the other day. No offense to anybody who went to Montessori school, and no offense to anybody who put their kids there. It seems like the kids were really well adjusted socially and totally independent and autonomous. I just don't get a model that says, here, 4-year-old, teach yourself to read. I'm just curious how that works out in the long run. Chris, what do you think?
I've seen some studies about the Montessori schools, and the kids who do Montessori through like elementary and middle are testing at or above their non-Montessori peers in math and science. So maybe there's another
lie propagated by the big Montessori industry.
Yeah. By big finger painting and self-directed education.
Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. But if you want to be part of Bing, this chat box that I think maybe just popped up on your screen, there's only one place to do it, and that's heading on over to the evil Google YouTubes and moving those phalanges, metacarpals, or just your entire skull smashed against the keyboard. Random ass characters will do, as long as you spoof the Google algorithm into creating a bunch of activity on this chat, and they'll put us in front of as many people as possible. We can save the world or deprogram the world one view at a time. Chris Vecchio, they liked him at 5,800, my friend. Is this like the last stand here? Are we making a last stand at 5,800? What do you think?
I have not engaged down here just yet, despite a desire on a technical basis to do so somewhat. Both ES and NQ are bounding around near multi-month lows. ES has erased all of the post-election gains. And in the process of doing so, it returns to its 200-day moving average. It bounces from there a little bit yesterday. It bounces from there today, of course. But really, has the momentum to the downside been broken? That's the question I'm asking myself. And one thing of note is that over the past 2 weeks, we've seen the S&P and the NASDAQ close consistently below their 1-week moving averages. That wasn't broken today. In fact, the 1-week EMAs proved as resistance for both NQ and ES in today's action. So if we can get ourselves above there, then you have a case to be made. Okay, we have some evidence that short-term momentum has been broken at a level that's been consistent with support in say, the past 6 months. There's a reason to look long down here, which again, I'm a momentum guy. I'm never going to blindly jump in with 2 feet like, say, Tony was yesterday and seeing the S&P near 57.91 and saying vol's up, I'm just going to sell some puts down here. So I will miss the exact low, the exact high in these turns, but the technicals look good. The question is whether or not we're going with a legitimate growth scare, or if this is a scare in the market akin to something that happened last July, early August. And I know that's been a point of interest that you and I have been discussing for the past 2 weeks, particularly after the PMI reading. It feels a little bit like late July, sentiment-wise, and surely enough, the price action for the past the interim week since we last spoke, I think kind of sticks to that environment.
I took a few shots. Last Friday, I bought some E-mini futures when we approached 5,800. Yesterday, I didn't feel as confident. So I didn't buy a ton of upside. The only thing I did was I sold a VIX, one of those big boy VIX futures. And at some point today, we were down 20, 30 cents or something like this. So I scalped out of it. I'm like you. I think the first time we got to 5,800, I think there was, from my point of view, there was like conviction that you could get this to hold. It doesn't mean the market is going to buy them here, but on a short-term trader's bounce, it's a decent risk-to-reward area. The second time, same idea, but less conviction. And it's just any upside, man, any rally is still getting sold into. And the momentum of the market, to your point, whether you're looking at the moving average or just the slope of the market, whatever, anything you look at here, the momentum is not great. But we've had I'm not the most technical guy, but we've had two pretty long lower wicks to the market over the last two sessions. In other words, we get to these lows in the market emphatically at any point under 5,800. It looks like there's some decent buying for the last 2 days. The question is, how long can that last? How long can they hold them here without some sort of catalyst, emotional or otherwise, to really get us moving in the other direction? And I suppose my question would be, if you go into the tail end of the week, do you see any short-term catalysts on the economic calendar or on the earnings calendar? Do you see anything that could provide some sort of solid ground to stand on from the market's point of view? Like, what would a strong jobs number actually mean? Would it be good in this type of environment? How do you break down what we see on the calendar for the rest of the week?
Yeah, I think we're back in a good news is good news and bad news is bad news kind of world, particularly for the non-farm payrolls. If it's a bad non-farm payrolls report, the first report that covers the reporting period entirely within Trump's term. So now we're actually moving into the data that is no longer from the Biden era. It's no longer straddling Biden and Trump. It's now becoming more Trump's data. So this is now the first report for February, of course, which encompasses the first full month of Trump's term. And we see from the PMIs, from the ISM, from the consumer confidence surveys that businesses, consumers are feeling more uncertain about which way taxes, tariffs, what have you, coming out of Washington's going, because there's just so much, for lack of a better phrase, chaos. It's not that the market doesn't like or want the 25% tariffs. I'm of the mindset that while that's going to be inflationary, it's going to reduce growth, net. The market just needs to know direction, right? If Trump came out tomorrow and said we're going to do 30% tariffs across the board and they're going to stay in place for the remainder of my presidency, I'm not going to back down no matter what, that would hurt in the short term, but we'd be able to do a whole bunch of planning then. We could project costs. We could say, okay, we need to source some materials from here or there. We don't need to worry about a tariff being slapped on in the middle of the night at a 3 a.m. tweet or a Truth Social post. We have some clarity about the future of policy direction. And it's one of those reasons why markets like gridlock in DC. Probabilistically, nothing's going to happen. So you can kind of just check the box and say, okay, well, inflation is going to be between 2 and 3%, and government spending is this, and yada, yada, yada. Right now, you can't make those kind of projections. So the uncertainty does hurt a bit. So then the non-farm payrolls, then, they are coming into the void. They're stepping into the breach of, are we in the midst of a growth slowdown? And the GDP trackers are doing us no favors with that conversation. Of course, the Atlanta Fed GDP now is plunged to minus 2.8%, a move largely driven by a surge in net exports, thanks to the fact that, well, what are we doing here? We are buying everything right now as soon as possible. I should say a collapse in net exports, a surge in net imports. But we're buying everything right now. We're basically front-running the tariffs before they go into place. Do recessions start when people are spending this much money on importing goods, when imports spike to the degree that they have? That's not something we have any historical bearing on. And that's part of the reason why other GDP trackers like the New York Fed Nowcast haven't keeled over to the downside the way that the Atlanta Feds have. So if we want to split the baby, right, we're still more than 2 or 3 weeks out from the official government release of GDP. And so consistent with a longstanding view I've had and shared with you, we don't really care about the actual level until about 2 to 3 weeks out, but we look more for the directional moves in these GDP trackers. And directionally, the New York Fed one is down from like 3.12% to 2.9 or so. And the Atlanta Fed, of course, is cratered from 3.9 down to negative 2.8. So I think we can make the case that right now momentum is weakening, softening for the economy. And so a non-farm payrolls report that comes in week that says, yes, indeed, those concerns are well-founded, the economy is rapidly deteriorating, would not play well for equity markets, which now are examining why we're doing rate cuts. They're no longer for maintenance reasons, they're for recession reasons, and equity markets do not like rate cuts for recession reasons, period, end of story.
Yeah. I wonder, though, let me ask you this question. I agree with that statement. It's sort of like this eternally true statement that the markets don't like uncertainty. However, you have I think in most cases, many cases here, you have your worst case scenario. So you have your worst case scenario from the United States, and it seems like in response, with the exception of maybe Mexico, which hasn't necessarily laid all their cards out, I don't think just yet, you sort of have the responses and not entirely from China, but you sort of have some idea of what they might do based on what they did last time around. So I'm just curious, don't you think the market has enough information to price the worst case scenario, but then you just have a really wide distribution curve around the potential of outcomes in that worst case scenario? Do you get what I'm saying? Like, it's not completely unknown where we're headed. The worst case scenario is known, and you just don't know if that worst case scenario is going to materialize. You don't know if we were going to meet Mexico somewhere in the middle off of 25% or meet Canada somewhere. Are we going to keep the 20% on China, or is that going to be negotiated down? But for the most part, you've got your worst case scenario and the retaliation on the table.
You do. And, I question how far this goes without reaching a place of other countries just being like, we can't negotiate with you. We're going to put up these tariffs. We're going to bear the pain ourselves. I think Trudeau's press conference yesterday is really illuminating, if only for two reasons. One, of course, he's going to take a tough stand. He has nothing to lose. He's on his way out the door, so he can be as pro-Canadian national interest as he'd like. But to that end, he pointed out that all
of a sudden he's not a globalist.
Well, but to that end, right? He says, Donald wants us to stop the flow of fentanyl. In January, we stopped less than an ounce at the Canadian border, right? And that's not to say that they're letting all of this through, but in terms of the seizures, you go from, like they've seized in 2024 of the 13,000 plus pounds of fentanyl that came into the United States, that was seized at our ports and borders. 42 of those 13,000 pounds came through Canada. And so they've now reduced the monthly flow rate down to less than an ounce. I don't know, Vic, that means year long, we're talking about, let's say 12 ounces of fentanyl coming through the Canadian border. That's basically tight can be. So what more can Canada do to prove to the U.S. that no, but this is, but again, Canada's port. You and I both know the reality is he's using reality, the fentanyl thing is sort of red meat to the base to oversimplify the trade negotiations with Canada. It's much easier to say this is about stopping fentanyl, and then everyone rallies around that, than the nuances around wanting, banks to be able to operate freely in Canada and all the other things he's like lightly alluding to. So and the increased tariffs he wants them to put on China so that there's unilateral strength from North America towards China so that they don't game his tariffs the way they did last time. So I think the reality of what we're negotiating for, or he's negotiating for, it's not the fentanyl thing. And so speaking to fentanyl is an attempt, I think, from Trudeau for the hearts and minds of the people, right? It's not a good faith negotiation, and neither is it a good faith negotiation tactic on Trump's side. What do you think Trudeau is doing? I don't get. You think he's trying to save his political career, kind of like Macron? What the hell is he doing? Or just save his legacy right now? I don't even think it's about saving his legacy. Like, on what pretext should Canada entertain any tariff negotiations with the United States if the pretext is wholly bullshit? Right? Like, Canada's not the source of this. As we know, as our own data shows, as the Trump administration readily admits, they've sent people out on Fox News, CNBC recent days, it's mostly Americans who are trafficking the fentanyl, because I can go back and forth across the border as an American and make day trips to Mexico, right? Same thing for Canada. And so, like, if the Trump administration's own data saying, like, hey, this isn't really a big problem. The Canadian government data saying, like, yeah, it is. But Trump's out there saying, hey, we're doing these tariffs under this emergency relief statute. We can do tariffs on national security grounds to address this crisis. And Trudeau's like, there's no crisis here, man. What are you talking about? Like, this is not a Canada problem, realistically. And so why should he have to play Trump's game? And I think that's the side of the equation that we're missing as Americans. We are, of course, the biggest economy with the biggest military, and we can do, by and large, whatever we want on the global stage. But other countries have national interests too, and they're just not going to be pushed around. And Trudeau has nothing to lose. He's not up for re-election, and his Liberal Party standing up to Trump has totally changed the polls in Canada. The Conservative Party with Pierre Poilievre was, 20, 30 points ahead at some points in the polls? Yeah, and now they're neck and neck. And it's because Poilievre is saying that we have to help Trump with the border. Canadians are like, you're trying to sell out the state. But Vic, this is all, I kind of had like an epiphany recently, because I'm working my way through a whole bunch of books on American history. And I finally got into the late 1800s. And as I'm reading more about these William McKinley tariffs, part of the stated goal of the McKinley administration in administering the tariffs in 1890 against Canada were to shrink the economy so that it would be pressurized to become a state at the time, which wouldn't be the 51st state. It would have been like the 40-odd something. But part of the stated goal of the tariffs under McKinley were to get Canada to buckle as kind of revenge for the 1812 war. And so we think about where we are today, and Trump's calling him Governor Trudeau and talking about these aggressive tariffs about Canada. And oh, by the way, saying how tariffs are the most beautiful word in the English language, and McKinley was the best president to ever do it. And we were at our richest as a nation in the late 1800s. I got to tell you, Vic, it sounds like he's serious when he says he wants to annex Canada. And I think that's what the Canadians feel. They don't see this as just talk. They see this as a legitimate threat against their sovereignty. So they'll dig in. We'll dig in.
I think these types of things can be used to enthuse a sense of nationalism. I think the reality is, I honestly don't know, and I don't want to presume to know, but I would imagine what we're really going for is solidarity when it comes to, eventually this turns from pointing the gun at Canada and Mexico to solidarity from the North American continent, and then pointing that gun over at China.
Sure.
I think that's what this is.
Yeah, Fortress America.
I don't think he really wants. Yeah, I don't think he's serious about making it the 51st state. Would we have MOUs or things like that in place? You see that all over the place in Southeast Asia. One nation does an MOU with another nation for specific resources, and we have that in our own way with sort of our version of NAFTA, or the new version of NAFTA. And you and Ilya talk about the renegotiation of this. I think it's really hard to deduce what's happening down to just like he's trying to strong arm Canada and he wants it to be the 51st state. I don't really think that's what this is about. I think there's a bigger game.
Let's say it is about the renegotiation of the USMCA.
Mm-hmm.
Vic, if you and I are negotiating on something and you say the pretense for renegotiating it is something that you and I can both independently verify as objectively untrue.
Yes. Yes.
Why, as your negotiating partner, am I going to take you seriously at all?
Because I've got a lot of cards. You know, because the pain, because collective plan. I know. I'm not saying it's. Look, I'm along for the ride with you, man. But I think the idea at some point is that we can bear more pain than the next person, and I hope that we don't put that to the test. But it does seem like that's where we're inching our way towards finding out who's got the greatest pain tolerance, and then at max pain,
sure.
and then at a max pain point
for more pain.
That's not what I voted for. I did vote for pain.
We voted for lower prices.
I know what I voted for. Do you know what you voted for? What'd you vote for? What'd you vote for?
$6 carton of eggs. Gustavo Fring, the chicken man, got my vote, Victor.
All right, man. Let's talk. If I know how you feel about the S&P here, which is, I think, bearish, at best case neutral.
Well,
how do you feel? Go ahead.
Yeah.
I don't want to put words in your mouth.
Yeah, no, so I'm looking for a little scoop here in the S&P long, but one of the trades that I was talking about in overtime today, which I'm reinitiating now on the Thursday session, is a short iron condor in the NASDAQ futures. Excuse me. Why? I think we're 42 days to expiration now in one of the NQ expiries. If we were to look at the one standard deviation move, rare is the occasion that it works out this perfectly, but the one standard deviation move effectively takes you back to the all-time highs on the way up and to the swing low in September on the way down. Now, if we were to treat the NASDAQ recent consolidation as a potential double top, the measured move brings you exactly down to that September swing low. So where does that leave us? Halfway between the September swing low and the all-time high. And if we were to put on a short iron condor trade here with basically I think it's like a 63% probability of profit I last checked, going 250 points wide between the guts and the wings, you're looking at basically a 2-to-1 risk to reward, risking 2 to make 1. And obviously NQ, it's a bigger contract, but saying that we're going to stay in the midpoint of this recent trading range for at least the next 20 days, if we're thinking of the typical like 45 and 21 day out tasty window, I think there's a pretty good bet that unless we see a market crash, that we're probably going to stick between those highs and lows. So I'm wanting to lean long deltas in ES, but I see a juicy opportunity in Q where, probabilistically, I think that's worth the roll of the dice.
This one, the NASDAQ looks even. It's been a while since I looked at the technical structure of the NASDAQ. Because I've been looking at the S&P, it looks even uglier than the S&P. It violated its lower bound. I did not see that.
Yeah, the NASDAQ looks gross, and it's kind of bouncing off of its 200-day, but it's still below the 5. And so could we see a big directional break? Yes. But 20,600 is basically the midpoint again of those lows in September and then the highs that we had in December. And 41.6 IVR, right? That to me is certainly a worthwhile look in the short term. And if we see that vol continues to spike and this thing starts to get really directional southward below 20K, cut it for a small loss. Because then it looks like we're going below 19K, at least from the measurement of this double top.
I think we're gonna move quickly below this bottom end of the range. I think we're gonna violate 5,800 and find a new range. And I think we're gonna put a lot of pressure on equities really, really quickly. But I personally don't think it would be a good thing to be fearful on that move. Like I just tend to think we're gonna find max pain, and that's gonna be a point at which it incentivizes the power structures to come together and negotiate. You know what I mean? Like I do think, and I think I've listened to a lot of people who have said this, I don't know how you feel, it seems like the Trump administration does have a tolerance for equity pain. I talked about this with Ilya yesterday. I talked about this on this show a week ago. I think the first administration, they used the S&P 500 as sort of this barometer for success. They constantly were cheerleading it higher. And I think it pissed opposition off. And I think to some extent, Biden administration ended up doing that same thing later on. I don't think that's going to be the case here. What do you think? It seems like they got a tolerance for pain here in equities. Do you agree with that?
The Trump put is not in SPY. The Trump put is in TLT.
Boom. Say more. Agreed 100%.
The stated goal of the administration is to bring down lower end rates because that will help boost economic activity within the economy by expanding credit availability. And more importantly, it will reduce the financing costs as we face a significant refinancing cliff over the next few years.
$7 trillion.
If we're, yes. And if you think about what Bessent's been saying, they keep acting as if they're targeting the 10-year yield because from which the 10-year flows, so do mortgage rates. And we think about anchoring any sort of risk or personal loan you're going to take out. But if you can bring the 10-year down, it's not yield curve control. But if you're implementing policies aimed at lowering inflation and lowering growth, you're going to get that, which is kind of the funny part of this equation here, right? How do you take term premia out of the long end of the curve? Well, you have to reduce uncertainty in markets. So a set policy direction helps. You're going to have to kill growth. You're going to have to kill inflation. Now, oil's doing its part. Right? Like the Starship Troopers meme. Like oil is definitely doing its part in trying to help that inflation conversation along. 66 and change for oil prices after a pretty steep pullback. That's not nothing. Gasoline futures, those likewise are falling. That's good. And if it means Americans have $10, $20, $30 extra in their pocket per week, it means a few $100 a year. And a few $100 a year can get recirculated into the economy in other ways. So lower gas prices are a good thing. Asterisk, as long as they're not down because of growth, which I think as everyone forgets, and this is one of the strangest things to me, people saying that gas was so cheap under Trump. Yeah, it was cheap in April 2020. There was a pandemic going on. There was no economic activity. Of course, there was no demand for it. Oil prices went negative in the futures market for a period of time. So we don't want gas prices low for that reason. But if it's because there's a lot of supply, thanks to, what I think will ultimately be a security arrangement with KSA, Saudi Arabia, they pump the oil, we give them the protection. It's a deal that George Bush turned down in the 2000s when he was offered a deal to peg oil prices at $25 a barrel for security guarantees and pass that up. So we're replaying history to a certain extent, maybe rewatching winding to a place where we should have been or not been. Of course, Saudi Arabia has a particular role to play in the 9/11 attacks, which we'll leave for another story, another episode of First the Truth, Victor. But that all aside,
That's a long episode.
But that all aside, right? Like if we're pumping more oil supply, we're going to get lower inflation expectations. There is kind of this also sense in my head where the uncertainty itself is a policy end to reduce activity.
Correct.
I'm probably gonna, am I personally consuming as much? Whatever I'm not buying that I would otherwise be buying and offsetting with my increased egg purchases, I am, and I make that as a joke. I eat 3 or 4 eggs a day. So like these egg prices being up, this is like this is personal, Victor Jones. This inflation is personal. But like outside of that, I know that I'm just waiting to see where things go, right? If I'm going to do my normal spending, of course, but like big ticket items, we're talking about getting a new car now sooner than we wanted to.
You just bought a car.
When?
I thought I bought a car and you bought a car at the same time.
I bought out my lease in January 22.
Yeah.
January 23.
I don't know.
But we need more room. So new car's coming. But like again, depending upon the car brand.
You having another one? Oops. I'm sorry. All right. So your 4 eggs thing threw me, and that's all I've been thinking about is those 4 eggs.
What do you want to know about them? Scrambled, poached?
Yeah, actually, I'm a hard-boiled egg guy. I have 4 hard-boiled eggs for breakfast, and then my wife makes a bunch of quail eggs. Then those quail eggs are like this big, and I just pop them like Skittles throughout the day.
That actually sounds delightful.
It is so good. It's the best. So I think you're still, so again, your negative growth here, which means you're sort of, until there's a resolution, you think there's more damage to be done in the S&P. Is there, like when we were going through this whole mess in 2022, we were able to look at a multiple and say, for this type of marketplace, when you have inflation above X, a typical multiple would be, let's call it 15 or something like this. And a 15 multiple on this market is Y price. Do you see the world through that lens right now, like an appropriate multiple where you would start to get interested, or are you looking more at the technicals as we sort of turn over and press support areas? Like, how are you looking at the market to know when you feel you'd be getting decent value to participate and sort of change your negative bias?
So I think a good example of how the market is struggling with this right now is to look at the reaction to Marvell earnings after hours here today. Last time I checked, they were down 13% or so after hours. They closed at 90.14. They're currently trading in at $78. This is a company that continued to beat, continue to do very well, but its guidance just wasn't high enough. And when your guidance isn't high enough, when you have a 70, 80, 90 PE multiple, it means your stock price is going to come down. You have to constantly guide higher, which is why I don't think it's a surprise when we look at, say, Tesla, for example. What's Elon Musk out there tweeting about when it comes to Tesla? How he could easily see that they're going to
1,000%.
You saw that too, right? And that's because, as the CEO of the company, you have to convince people that with that type of price to earnings ratio, if you're investing $1 today, you're not getting paid back basically in your lifetime, right? So you have to convince people that the growth is going to come. And so you have to be a salesman, a P.T. Barnum of sorts. And so you have Marvel beating today and the market saying, no, your guidance to go higher is not good enough. Same thing with NVIDIA, right? It's good guidance. It's not the great guidance. It can't justify the price to earnings ratio. Whereas in bull markets, none of that stuff matters at all. It's like, oh, we beat, fantastic. Who cares? Put more money on the board, right? Oh, the PE is going down. Well, we liked it at 70, and now that it's a 55 PE, we might as well pump the stock price back to where it's at 70 PE. That's just not the market reaction function right now. So things that are occurring in bear markets in the price action are happening, right? I think that sharp reversal we had seen in stocks a few days ago, where you effectively clear out the Friday high and then you trade below the Friday low, right? And you can't break short-term momentum indicators. That's just one of those things that on the flip end, we were seeing all the time in the bull market. Every time we tried to break down, we're immediately purchased back up against the 1 week moving average. The momentum profile never deteriorates. This time it's only staying deteriorated. So I'd like, are there buying opportunities idiosyncratically, individually? Sure, right? Mag 7 here is 16% off of its highs. Buying dips at 10% or more in the Mag 7 over the past 15 years, depending upon what names are in there for survivorship bias. You're talking about one of the best trading strategies on planet Earth over the past decade or 15 years. So will people throw that out the window right now? Probably not. But the indexes don't look healthy. There's a lot of chop still. Seasonally, we chop around until March 15th. So perhaps that coincides very neatly with the news flow, whereby we're going to have this tariff on, tariff off, exemptions for this, not for that, retaliation, yada, yada, yada. And then finally we get some, okay, next week, the week after, by then we have some clarity. We have a plan in place. Trump and Trudeau and Sheinbaum agree that tariffs will stay suspended so that, trade representatives can meet to renegotiate the USMCA and just avoid the whole tariff tit for tat altogether. Let's just get to the meat of the issue. Markets are going to love it. They're going to love it, even if the economy looks poorly. Certainty is what matters.
I think he can't do that again. I think if he keeps doing this pause shit, I think it'll be like the boy who cried wolf. I think the tariff shit is not going to work for him at all as a strategy. I think it will literally go away as an ability to sort of boss. I think it's to change the leverage in negotiating. In all manners, the goal. On all manners, the goal is to change leverage in negotiations. And I think if they keep doing this on pause, it's not going to serve any of their goals at all. And I think that's what they're running into right now.
I don't know. I think enough people get frustrated by, the Calvin Ball aspect of the tariff, the Michael Scott snip, snap tariffs, right? And people just kind of throw their hands up and go, you know what? I can't plan for a future where this is going on and off. I'm going to cancel my expansion projects.
Yeah.
I'm not going to hire.
That's what I'm saying. It becomes real at that point. And what I'm saying is, whether you want them or not, they get priced. So you kept doing the bullshit back and forth dance, and so when they're priced, that you can't use them as negotiation anymore. You get what I'm saying? Like at that point, they're no longer leveraged because it doesn't matter.
But if the actual economic impact of injecting this uncertainty and confusion is that the economy slows, then you get a lower 10-year yield.
Of course, you need to create demand for the treasuries because you got $7 trillion that are going to come online that you got to pump to the marketplace. That's one factor of what's going on for sure.
I think I think one of the most difficult things about this and why we have to piece together all these puzzle pieces, there's not, if there's a single impulse here, it's Fortress North America. That seems to be when you put together all of the commentary from various people in Trump world, from Trump himself, from, Project 47 or Project 2025, whatever we call it these days. You can see that there is an idea about balkanization of global trade, that the world is ruled by great powers who have spheres of influences, and the United States sphere of influence is the Western Hemisphere. And the Western Hemisphere is not the West, right? The West includes Japan, South Korea, Germany, France, yada, yada, yada. But the Western Hemisphere is explicitly Canada, North America, Mexico, and then Latin America, right? And, I've long been a proponent of like a Monroe Doctrine for the Western Hemisphere. I've long said that if you're going to solve the problem of illegal immigration at the southern border, you have to address the economic issues in those countries. The gangs are driving people out. So if you want to stop people fleeing these countries in fear of their lives, stop the violence in those countries. Why is there violence typically? A lot of it's linked to poverty. Why is there poverty? No good economic prospects. Okay, so let's help those countries develop the economic prospects so people feel like they don't need to turn to violence and crime and instead have a legitimate way to build a life as opposed to stealing from one another. We see this all the time throughout human development, right? It's not new. And if we can actually focus on that, if that's what Trump's trying to do, it may be ham-fisted, but if that's the result of a Fortress North America, of a Western Hemisphere new Monroe Doctrine, that is not going to be terrible for stock markets longer term. And a robust Europe is probably good for the global economy long term. how long have you and I chided Europe for being a deindustrializing, unserious group of people? And now they're finally acting like a major world power, talking about raising an army. And Macron put out a tweet today how they're reviewing how to extend France's nuclear umbrella. Proliferation is coming. If you are now a state in the world and you don't have nuclear powers, you better find a poppy who does. And if you don't have one, you need to develop your own. Otherwise, you are completely left at the whims. You have no deterrence. It's one of my least favorite things resulting from how we've handled Ukraine. Whether or not we should be supporting Ukraine or not, let's have that conversation a different time. But the Budapest Memorandum stipulated we'd protect them if they gave up their nukes. And now we're pulling back support. Again, if I'm any other country on earth, my first question I'm picking up the phone yesterday is, how can we get our own nuclear weapons?
A lot to unpack there in only 3 minutes, or only a minute. So I'll leave the Ukraine thing alone. But I'll give you a pick'em for either your quick thoughts on the speech last night. I think it was last night. I don't know. My days and nights are all turned around. I think it was last night.
Yes.
Or RFK's seemingly just brutalizing his own political reputation over the last week or so. I'll have to give you a pick'em. You go any direction you want to there.
So interesting how you think that he's only brutalized his political reputation over the past week or so. But
yeah, I think so. I think he built his political cachet into that election. I think it was stronger than it had ever been politically, and I think he's dunked on himself in the last 5 days.
Yeah, I mean, like with respect to the speech, I think it was pretty much Trump doing what one would expect. I don't think there was any significant surprises that came out of it. Very MAGA. And when you look at the news and TV audience for the speech, I think something in the neighborhood of 70% or 60% of the people watching were Republicans themselves, and then it was split between Democrats and independents fairly evenly. So it was a speech for a specific audience. Personally, like given where I stand, Victor, I just got to say I'm a little disappointed with how the opposition party behaved during some parts.
No.
It really shouldn't be seen as controversial to clap for a child who survived brain cancer. And I think that the people who I find myself usually associating themselves with should find some space for introspection here.
Amen, bro. I agree with that. I also think I think in a way there's a group of people, the largest group of Americans are in the middle. And I think there's one thing they don't want more than anything else, and it's additional political theater and theatrics and sort of an immature look from the government. And I think there were some parts where it just didn't look, the signs or whatever. I get it, it's messaging, but I think the decorum, it wasn't a good look in my opinion. The optics weren't great.
Well, that's one of the things I've learned, Victor, reading through my traverse through American history recently. I tweeted it out last night, but canes being swung around on the Senate floor, it's not new. It's not new. It ain't new.
I know.
And the last time it happened, it may have led to the Civil War. So that's actually,
Yeah. All right, Chris, it's going to be an early day because you got to visit a school. So do me a favor, if the people want more from you. What?
It makes this odd phrasing.
You got to visit a school.
What, man?
There's no context to that.
Going to a parent-teacher orientation. Not just hanging out.
You got to go hang out at a playground.
7 o'clock at night when it's raining, Victor Jones. Don't put that on me.
Tell the people where they can go.
Here on Tasty Live, not at the school. Monday through Friday, Futures Power Hour, 1 p.m. Eastern, 12 Central Time. Monday through Thursday, overtime, 4 p.m. Eastern, 3 Central. Let Me Explain with Tom and Tony, Tuesday mornings, 9:40 a.m. And Victor Jones on Wednesday, The Price of Truth. Of course, find my latest rants, musings, and pithy on Twitter, X at CVecchioFX.
All right, Chris, appreciate it, bro. Have a good one. Go hang out. That's cool, man. I'll see you next time. Oh my goodness gracious. Chris Vecchio, everybody, we got a little bit more time, so we're going to hang out here. We're going to run a little solo show for the last 15 minutes or so. I'm curious how you got pickled quail eggs are excellent while riding in a rumble seat. So I don't know how you guys are playing this. I don't have strong convictions here about bonds after we got up to like 119. I don't have strong convictions, so I'm neutral here in bonds. I don't know if that's surprising in any way, shape, or form, but I'm back to neutral at around 120. I think on the equities, as I said before when Chris came, I told you guys, fool me once. I think we picked up the 5,800, and it got a nice market reversal that only lasted one day. And I think coming the second time testing 5,800, we're still getting a decent price if you believe that the market can hang around in this range for a little while longer. So it's a decent risk to reward, but I thought the risk reward was closer to 50-50 this time. So instead of taking like a real big position, I wanted to bet. I bet on vol, sort of just hopefully they're staying the same or coming in just a little bit. And I think I got lucky more than anything. Vol did come in a little bit today, but I didn't take a real big swing. And I'm curious if any of you guys are taking big swings on the S&P at 5,800, because in theory, we've been in this two-sided range for 4 months. We are at the lowest price in that range, which means if you believe you can continue inside this range, you're getting the best possible price for the range. I just don't have the confidence that we're not going to violate it. And I think, I could look at the NASDAQ, which has violated the bottom side of its own range. I could look at the Russell. I could look at almost everything else except the S&P, which has violated the downside of its range. I can go to individual stocks if you want, where we've drawn out this two-sided range where we've been in a lot of cases, man, we've violated the downside of these ranges. And I don't have any reason to believe that ultimately doesn't happen in the S&P 500 as well. But the only thing it had going for it, and one of the reasons I took a stab, was because of the VIX and the vol term structure. Yesterday we got into backwardation, and I just for kicks wanted to see if I could sell front month futures on that first day of backwardation. These tend to be really interesting points to take some to take a little bit of upside or long delta risk, because there's few things that are mean reverting or that end up normalizing over time. A yield curve inversion is one of those things. The VIX term structure going into backwardation is one of those things. It doesn't mean, like, a yield curve inversion doesn't have to reverse the next day, right? You go into a yield curve inversion, you might be there for a while. You go into VIX backwardation, you might be there for a while. I forget the actual length of time, but back in the great financial crisis, we went into VIX backwardation forever. It doesn't happen very often. I want to say something like 150 days, maybe longer than that. That is an anomaly. So when we get into VIX backwardation, knowing that volatility is a mean reverting asset, and knowing that that's an anomaly of a term structure, I like to take little bets. Start to take little bets. And that's what I did yesterday. It was just a quick scalp, and I'm now flat. And the question is, if we can break, this sucks because it's like it's sort of antagonizing, just teetering here at 5,800, because if you can break this, we'll probably flush, and we'll flush fast. We'll find some new end of the range or establish some new range. You'll get a VIX backwardation, will likely steepen a little bit. And then, all of us, we can get out our pickaxes and we can create a new range in the S&P 500, which will likely find new structure. And I think that's the more likely scenario. Than we continue to build inside of this established range. I think that's probably the more likely scenario. And it probably is a technically triggering event, which was why I think you go find a new price rather quickly. But because of that, I don't know, I might have the wrong mindset, but I'm not afraid of stair-stepping into a new range. And I think I'm personally looking for those opportunities as we step into a new range. What do I want to buy? At what levels do I think I'm getting a fair price? what vols levels would I look to sell puts, or more likely put spreads, just in case I'm a bit early. I don't want to be wearing some of this stuff. So yeah, I think that's my mindset as we get ready to potentially violate the downside in the S&P 500. As they say, failing to have a plan is planning to fail. And I just think I don't want to wake up and I'm surprised that the SPOOs are down 2%. And VIX is spiked up to 27, and the VIX is in backwardation, and they're running a markets in crisis headline on television. Like that, I don't want to be surprised by that. And I want to be in the right mental model and the right mental, the right mind frame when it happens, if it happens. Short MES with a short put, says Lobo. Are you shorting TLT? No, I'm not, Brian. I can't figure out what I want to do here with bonds at 120. I think it's a hard bet. Like, I do think I'm probably getting a good price to start working on the other direction. I've wanted to get short the long end of the curve. But what's happening is I'm going to have to rethink about where my estimate of the long end goes as the market is repricing where it thinks the short end should be. So clearly, the market is now pricing in more cuts, right? We've got a cut in June, a cut in September, and then a cut in December, and they're working on the cuts in 2026. So the more growth slows and the more that starts to show up in the data, likely the more cuts the market is going to beg for. And I don't know what the tolerance is going to be from the Federal Reserve to give the market those cuts. I'm not quite sure. And so wherever that short end ends up, that sort of dictates how I think about the curve, because the whole curve can move. So even if I think it's going to steepen, if it doesn't steepen until after a big shift in the yield curve, I've got to be careful not to get caught. So I think two things are happening at once. I think I'm probably getting a decent price to start going short, but I also think the whole curve is shifting lower, which then nullifies my desire to want to get short the long end. I don't know if anything I said just made sense, but I'm trying to talk you through my indecision on reestablishing a short, because this is what I waited for. I thought a tactical long in bonds made sense, and I said at 120, that would be an interesting level to start reversing. I got neutral, but I haven't fired against it, and maybe that's wrong. Maybe the indecision is what's wrong here. But I don't have full conviction, so I don't want to put chips on the table if I don't have full conviction, because what will inevitably happen is the instant the trade goes against me in something I'm not fully convicted to, I'll just run away like a big scaredy cat and get stopped out. So I don't want to do that. Let's see here. Want to sell bonds, buy dollars, but I'm torn, says Son. Yeah. I like the contrarian aspect of that idea, Son. Especially the long dollars. Nobody's saying that right now. If ES dives down, then won't bonds go up? Dev, I don't know. That's the real point. What I do know is that the last 2 days, you've gotten a very different action in yields, right? They're starting to inch up again over the last 2 days. So while you had a flight to quality, while you've had a bid in bonds, the last 2 days is starting to look a little bit different. No, I don't. I think if the ES dives, the typical relationship in a flight to quality is that actually treasuries get bid. So people buy bonds. That's your typical correlation. It does not have to happen. And oftentimes that correlation can and will change. It just depends on the structure. But what has happened for the last 2 weeks is as markets were getting weak, the market was buying bonds. So the correlation was sort of inverse, which is what it typically is. That's why people create like 60-40 portfolios, right? 60% in equities, 40% in bonds. In theory, that's a hedge. In theory, So as stocks go down, in theory, your bonds are going up in price. So that's sort of the idea behind the whole 60-40 portfolio. It was put together because they had that inverse correlation, but only really, honestly, since like the 80s on. Prior to that, I don't think that correlation actually existed. Shout out to Jem Carson who brought that to my attention. Let's see here. 4,800. Let's go, says Jay Wright. I'm curious, why 4,800? Is it just is it a technical line on the chart? Is it a multiple? Is it just a number that you like? Because I've heard 4,800 spit out a lot, and I'm curious where it's coming from. CM says fact. That's really an opinion. Far more likely it will be suddenly down 2.5% than up. I honestly think it's 50-50. I think the odds are 50-50, honestly. Let me say it like this. But I think there's a fatter left tail. I think if you move higher, we could get a 1% up day. Like we did today, a 1.5% day. I think you can get a relief rally to the upside. I think if you violate 5,800, I think we got a fat left tail, the potential for kinetic motion and energy to the downside really quickly. So I think the pot odds favor the downside only because there's probably the magnitude of the move probably favors the downside, right? That's skew. Just like everything else, you can't really make a good guess without knowing a few things. Not knowing for a while, slow down more likely, bonds up more likely. I do agree with that, CM. That's what makes this really hard. Is if your bet is stagflation. So my question is just, what do they do if we really are going to lean into the potential and flirt with the reality of a manufactured recession? Politically, I think you need to understand how difficult it is to weather that storm politically. And again, everyone talks about, what happens if we lower our debt? Now we can refinance at a lower price. That's a positive. Yes, it is. What happens if you get lower home prices? People can now afford to buy a home. That's a positive. Yeah, it is. What happens if stock prices come down? That means our generation is going to get an opportunity to buy things at more reasonable valuations and prices. That's a positive. Yeah, it is. But those things, in my personal opinion, it's hard to have those things happen in a vacuum. That, to me, that's like ceteris paribus in economics. It's a dangerous word. All else equal. All else equal, and bonds come down. That's great for refinancing the U.S. government's $7 trillion in debt that comes due this year. All else equal, home prices go down. That increases home affordability. All else equal, stock prices coming down increases the ability for millennials, Z, and newer generations to create upside upside wealth for themselves. But the problem is all else equal only exists in the textbooks. Problem is it only exists in a model. In reality, you get lower bond yields because of slower growth, and slower growth has the impact of impacting people's jobs. You get lower home prices. Ultimately, very rarely, and in most cases, it's because of economic growth slowdowns and people have lost their jobs. You get lower stock prices, and in response to maintain shareholder value to lower stock prices, CEOs and boards will make their businesses more efficient to increase shareholder return under the pressure of lower stock prices, meaning people lose their jobs. So my question is, politically, with all the positives you can try to sell about lower stock prices, lower home prices, potentially lower gas prices, and maybe even lower financing costs of the U.S. government, there's a problem here we're not talking about. And that is, I don't care who you voted for, if you lose your job, and it was a manufactured recession, you're probably going to be angry at whoever pushed the button to make it happen. And that means for political survival, and I know Trump himself can't run for a second term, or I mean another term. This is his second term. The Republican Party has to figure out what to do in midterms and then after this presidency. And if we're headed towards a world of growth slowdown and some material recession, which could then bring down the price of these things, you have to understand there's no just magical world where prices come down and everyone also keeps their job and everybody's wages are untouched. If not, they go up. That magical world probably doesn't exist unless we find some new labor input that is much cheaper, or we find some new energy source that is much cheaper. That magical world probably does not exist without pain. And so I just think that pain will be felt somewhere. And how do you deal with that politically? Well, what you typically do is you try to buy back your constituency, right? There's one thing I've learned about following politics as an adult human male. It's you can buy votes. There's ways to legally buy votes, and that means, my friend, that the government's got to print money in response to a slowdown. And what would happen to yields if the government is moving from 6 or 7% of debt to GDP to something north of that in a response to a slowdown? And if they don't do that, if they don't respond fiscally in a slowdown, how bad could the slowdown get? Get what I'm saying? Like this, at some point, if we're actually going to play this game, it becomes another game of chicken. In 2022, we played a game of chicken with Jerome Powell where he pretended to be Paul Volcker. And we all knew it's just a matter of time before you cave. And it's like, what's that pain point? And I think the question is for the Republican Party, if your first budget was adding $2.8 trillion to the deficit from now until 2034, and we're not in a slowdown yet, what does that budget look like if we're in a slowdown and people need assistance and you care about your political future? I don't know. So I think that's the CM. That's a long way of saying that there's a push and a pull, I think, on how to think about yields. And the question is, will the government respond the way that they typically would for their own political incentive structure, which is to maintain power? In a slowdown, how do you do that? You print money, you give subsidies, you come up with new programs to respond to an economic slowdown. Otherwise, people will see you as ignoring them. You created this slowdown and you're ignoring them. You're not helping them in this moment of need. And you're going to get a complete political pendulum shift to the other side. So what's their pain tolerance for that? I don't know. And that's what I think makes the thinking about the long end, in my personal opinion, a little bit more difficult and less straightforward. CM says 100% fake. This is what Trump and most of his supporters don't want or cannot understand. I don't know. I can't speak for everybody, but I think Chris said something at the beginning of the show. This is what you voted for, something to that extent. And I'm here to tell you, I know exactly what I voted for. And I've said it on the show in the past that somebody's got to take the pain. It's either me or my kids or my grandkids. And if none of us take the pain, we just keep cruising towards authoritarianism and increased wealth inequality. So if we want to reset to something that looks a little bit more like a free market, that looks a little bit more like real competition, then it's like there's no clear path there without the pain. And I'm aware of what that path looks like. And I'm willing to go through those hard times. I think I am, right? But I sort of think be careful what you wish for. But I think I can endure a lot if I believed in my heart that on the other side of that endurance, that a better world existed for my kids and for other kids. And I do believe that's true. I might be naive in that belief or just wrong, but that's my view of the world. I'm ready for it. Besant did say on CNBC it's been Wall Street's turn, and now it's time for Main Street. So interpret that as. I thought he said it. Didn't he say it the other way? Taif, I think you said that the other day. I didn't see that comment. I only saw that was a few days before his interview on Bloomberg. But didn't he say it's Wall Street's turn? Like Main Street's, and now it's Wall Street's turn, meaning the pain, it's time for Wall Street to take pain. I thought he said it flipped, but maybe I'm wrong. Jay Wright says 4,800, just a number I like, and it's an overshoot under 5,200. Nice to know others smarter than me like it too. I see. Thank you, Jay Wright. That magical world does exist in the minds of most of the base these days on the right. I don't, maybe, but I think Trump has said it a couple of times, and this is the guy who will never give bad news. He always reframes bad news in a positive light. But he said something to the extent of there will be, what was the word he used, which I thought was hilarious. But I can't remember the word he used, but I think he even said it yesterday. But there will be some sort of, gosh, man, I wish I could. It starts with a D. I can't remember the word. Basically, some sort of issues, ahead. And I think Elon many times on Twitter has alluded to the idea that likely we'll go through tough times as a result of some of this stuff. Tariffs, inflation will be transitory. I actually agree with that. I think you're being sarcastic, CM, but it is everything I've seen on paper and modeled. It's a one-time price shift. So I don't know. And then they make cuts to that there is no world, there is no pain, there is no world where we go through pain and we all suffer equally. I think that's unrealistic. In good times, the working class individual benefits but doesn't benefit as much, and in bad times, the working class pays the highest price. And I think if we're going to go through a period of pain, it's just the structure. It's just the structure of our system that we're not going to all pay an equal price. Unfortunately, I'm not a champion of that. I don't like that fact. I'm just speaking to what is real, right? If I've got a lot of money, I have the potential to buy political influence and ensure that my personal interests are protected, or at least somewhat protected, into a difficult circumstance. Whereas you, as a working class individual, or if I'm over here, I'm a working class individual, I don't have that political influence. I'm at the whim of an employer and to the broader economic strength. At some level, it's my own skill set. Do I have the skill set to continue to monetize my own skill set? Have I put away things for a rainy day? Yeah, sure. But I'm going to suffer on a disproportionate level, and I'm not going to benefit to the same extent in good times. And I just think that's the reality. And so I don't know that I want to be angry about that. I'm going to try to find the right way to say this. There's no way to change that reality in our current system. But if we go through a period of pain, now we've reset the game where we can now all compete on even footing. Theoretically, if the right decisions are made. I don't think if we just have a recession and we don't change any of our economic dynamics, I don't think that's actually going to help anybody. If we go through a recession and we increase our deficit massively and plummet even further our purchasing power, I don't think it helps anybody. But there's sort of I'm willing to go through the pain if everybody collectively is willing to go through the pain as well. And we are going to have a stronger purchasing power on the other end. We're going to have a more competitive economy that is less concentrated to 1, 2, or 3 companies in each of our major industries. We're going to have less protectionist regulation. I'm not one of these guys that are just like cut regulation. Like I don't want, no offense everybody out there, but I don't want gunk being dumped into the water table. That's not the type of deregulation I mean. I'm going to tell you what I mean. A guy came over I got my furnace replaced a few years ago, and these two guys came over. These two guys were incredibly knowledgeable, and I'm the most annoying person in the world, especially about things I don't know. So for maybe 3 or 4 hours, these guys, they did their work and they let me ask every question under the sun about my HVAC system, because I just bought a home. I didn't know anything and I don't like to be scammed. So I ask a lot of questions so I can be somewhat informed. These guys answered every question. They showed me nooks and crannies, took pictures, gave me links and sites. And I asked these guys when we were done, I was like, one, you guys have incredible patience. 2, you guys worked incredibly efficiently in order to get your job done and also answer my questions. Like, have you ever thought about doing this on your own? Like, why are you working for so-and-so? And they said, it's the licensing. Like, in order to pay for the licensing, in order to pay for the insurance, in order to pay for all these things, in order to set up a business, it's sort of cost prohibitive. And so until we save up enough money to get that amount, which they told me, it's sort of we got to keep doing this. And this thing paid them, good, but like if you were making your own money selling, the cost. Let me just say this: the cost of labor was much higher than they were getting paid for that time they spent with me. And so I'm down with deregulation that helps guys like that start their business instead of working for a few dollars an hour. That when I say deregulation, that's what I mean. I don't mean just allow some mega corporation to dump PFAS in the water table. That's not what I'm talking about. So I think if we went through pain in order to restructure an economy, bring down some of this monopoly power, deregulate to the extent that the everyday working class individual could start a business on the up and up, not just something that they're hiding from the IRS and getting paid in cash, all that stuff. To me, that's a pretty good world to get to. But I agree with you. It probably is a little bit idealistic and in some ways perhaps unrealistic that you could get to that better world on the other side. I don't know, but a guy can hope, right? Vic, sorry, man, but I wasn't happy with the status quo, but this a whole other dystopian thing. Nothing about this reduces income inequality or even gives two shit about actual people. Should be Chris. I'm with you. I understand what you're saying. I guess it just depends on what you believe is the core of our problem. I believe the core of our problem, because I've spent enough time trying to figure out, caring enough and trying to figure out what is the solution. I've gone down the rabbit hole on most of the issues far enough to realize I think the core of all these problems, if you follow it far enough, it ends at the money. And I think the lack of protection for our purchasing power will help many, not just in this country, but I also think the destruction of the purchasing power is also what allows us to maintain economic dominance over mineral-rich developing nations. So I believe purchasing power is really, really important, and I believe Citizens United is really, really important. If I believe incentives are the key to understanding your outcomes, then I think as soon as you allow unlimited amounts of money in your political system, you have taken power away from the majority and you put it in the hands of capital. And I think again, that's all coming back to money. So I think you follow our problems far enough and you got to figure out ways to fix the incentive structure at its core. And I think coming up with new programs, these types of things, they feel good and they sound good. But if you let them run long enough, it doesn't seem like, it seems like most of them end up suffering some sort of internal rot and doing us more harm than good. And maybe this is just the point in the journey that I'm at, and I'm going to discover a new level of sort of enlightenment, if you want to call it that, and I'll have a different point of view in a few years. But right now, you can give me a program, and I can tell you how it both helps and hurts. And if it helps and hurts, then really it was just a program to sell to some constituency to get votes. And if there's many winners as there are losers for these programs, then what are we actually doing with them? Wouldn't it be better just to let you keep the money you made? I don't know. I know it's a weird thought, I guess. All right. This got weird the last 10 minutes. My apologies. Your thesis seems to support the idea of small cap outperformance in that type of scenario, money directed towards small business rather than big corporations, or at least change in percentage of these flows. Yeah, I think you could say that. I think just generally speaking, I am leaning against. That's why all the relative trades I always have they usually have a short NASDAQ lean. If I'm long something, I'm short NASDAQ, and that's because that's the greatest concentration risk. So I think there's a decent opportunity there when and if the market finally decides that either these 7 aren't the 7 for the next 10 years, or that 7 companies doesn't make a lot of sense. To have 40% of the weight of a 100 stock index. I just think there's a lot of risk reward there. And so I suppose you could extrapolate this out to long small caps over other things. But I'm talking about small businesses to the extent that a lot of these people are not going to go public, right? Not that type of small business. I'm talking about more restaurants, more corner stores, more, individually owned HVAC companies like that. That's what I'm talking about. I don't know if that's necessarily tradable, but I think at some level you can extrapolate that out to what you just said. But should we have economic dominance over mineral-rich developing nations? Should be, Chris. We're getting into some heavy territory here. I think there's different ways to be the strongest person in a room. All right, there's hard power and there's soft power, and I think your view of the world is going to be dominated by whether or not you lean more towards hard power or you lean more towards soft power. I think most of the world are business people, and I think if you're I don't know, some rosy idealistic part of me thinks that we can be utilizing more soft power in the world, and that we can be creating more fair synergies than IMF loans that leave people in sort of an economic doom loop. I don't think that's the way to go. CM, that's my most bullish long-term play. See, we've come together. Vic rocks. Oh, I don't know. Modern monetary theory says the U.S. needs to be dominant. Brian, what do you think about MMT? I read that book. Definitely. What is it? Oh, I forget the title. I'm curious. What do you think about MMT? Seems like that's where we're headed. Scary as shit to me. Oh, Victor. Oh, wow, Victor, you banned me from live chat. Oscar's Moving Company. I didn't ban you, man. What are you talking about? Yes, the deficit myth. That's it. Thank you, son. All right, everybody, that's going to do it for me. We're gonna shut this down a few minutes earlier. A little bit random takes at the end of the show. My apologies. It wasn't as lucid, I think, as as some of the other Q&A sections, but that's okay sometimes. Oscar's Moving Company, you banned my other account. Oscar, my friend, I don't ban anything. But if you want to send Tasty Live an email, you can figure it out with the moderators. I didn't ban you, my guy, or my friend. Yeah, I didn't do it. I don't think so. If I did, it was a total accident. Maybe I was just banging my face against the keyboard and pressed something on accident. But I don't play with the moderation stuff. I just respond to whatever questions are in there. But yeah, chat in or send Tasty Live an email, and we'll figure it out, Oscar. Everybody, I appreciate your time. Thanks for hanging out with me for nearly 90 minutes. Thank you to our special guest, Chris Vecchio, who's hanging out at a school somewhere right now. I'll see you back here tomorrow. Same time, same place, same great network. And I'm wondering whether or not when I see you tomorrow, the world from an equity pricing standpoint will have changed. I'm kind of hoping it will, so we can get rid of this antagonizing sort of just looking over the ledge without stepping over it. If we're going to do it, paint or get off the ladder. Let's go. I'll see you tomorrow. We'll see what's on the other side. Peace.